touched every aspect of life in Israel, including the financial markets and our daily operations. It has tested our resilience and determination, but as always, the people and businesses of Israel are responding with strength, unity, and resolve.
The hedge fund industry, by its nature, is one that thrives on navigating volatility and uncertainty. And we are in time that demands that very expertise. Our main goal was to demonstrate our support, trust, and gratitude to the members of the Israeli hedge fund community and to our friends and affiliates, both locally, domestically, and globally.
We are delighted to host you here. I want to say that when you see the way our markets have been performing in this very challenging year, it clearly shows the resilience not only of our people, of our nation, but also our economy, our employees, and everything that makes this country up and running.
3, 2, 1. The market is open.
Good morning, everyone. Welcome to the 11th Annual Conference of the Israel Hedge Fund Association, the IHFA. It is a real privilege to have you all here with us, and I want to thank each one of you for attending, especially during these challenging times we all go through as a nation. For those who don't know me, my name is Natalie Raz, and I'm the CEO of the Israel Hedge Fund Association for almost 3 years. As we gather here today, our hearts and minds are with all those affected by the ongoing conflict. Israel is undergoing challenging times, and we stand in solidarity with all the brave individuals, soldiers, first responders, and civilians who are working tirelessly to defend our country and protect its citizens. Our hearts on this day, as on every day, are with our hostages in Gaza, with the soldiers who are fighting the fight, and with those families who lost their loved ones. The hedge fund industry, like other sectors in Israel, does not exist in a vacuum. We are part of the nation's fabric. Despite the continuous war, the industry continues to grow, adapt, and contribute meaningfully to Israel's economy. Even as the conflict disrupts our daily lives, it is important to remember the vital role our industry plays in the capital market, driving efficiency, liquidity, and stability. Israel hedge funds manage in the aggregate approximately $21 billion in AUM and play an equally significant role comprising a substantial portion of the trading on the Tel Aviv Stock Exchange, thereby enhancing market participation and liquidity. Further, as our local industry matures and experiences a substantive growth, local hedge funds acquired a level of expertise comparable to global peers, and many reached an institutional-grade standard complemented by remarkable flexibility and agility, making them an attractive option for both local and global institutional investors. The responsibility that comes with managing capital during uncertain times cannot be overstated. Hedge funds have a unique ability to navigate volatility, and it is during periods of crisis that our agility and expertise are most needed. I want to take this opportunity to thank all the hedge fund managers for their professionalism and dedication in these dire times, and for keeping the bar high for the Israeli investment industry. באמת, כבוד. לא פשוט. The IHFA has worked tirelessly to support its members, from regulatory advocacy to professional seminars. While the war has changed many aspects of our life, it has also underscored the importance of unity, collaboration, and resilience. Over the past year, we have focused on strengthening our community and raising the professional standards of our industry. This work will continue as we believe that a strong hedge fund sector is essential also for the long-term prosperity of Israel's economy. For over a decade now, the IHFA has supported the industry and facilitated its growth and enhanced standards. Our firm industry position in the market led us to diligently collaborate with the stock exchange for the purpose of establishing joint ventures, innovative initiatives, and novel ideas, all aimed at supercharging Israel's capital markets and on a broader scale, the entire local economy. I would like to take this opportunity to extend my gratitude to Mrs. Hani Shitrit from the Tel Aviv Stock Exchange. Hani, are you here? Really? Okay, for her tremendous help with this event and to the IHFA throughout the years. So, what has the association done over the past year, and what will it focus on in the year ahead? Over the past year, we focused on the professional development of our members, supporting our members during the war on the regulatory initiatives. We have provided our members with various seminars and webinars, and we will continue with this professional training for many years to come, as we believe this is critical for the success of the industry in raising the professional standards of the hedge fund industry in Israel. All the seminars were conducted with members of the IHFA who volunteered their time and knowledge to enrich and support the local industry. From our first seminar aimed at helping emerging hedge funds at the beginning of their journey, to seminars and lectures aimed at supporting more mature managers. Last year, we launched the IHFA website, which states the mission and vision of the association, and lists our members and the IHFA Board of Directors. We will continue to expand and develop our website and add additional services and professional information for our members. The IHFA is also focused on regulatory issues. Our regulatory advocacy has focused on two key goals. First, safeguarding our achievements and defending our interests against both local and global political turbulence. Second, actively advancing our objectives. This has been quite challenging, but I'm pleased that we have managed to protect and promote several of our key interests with the relevant authorities. Advancing these interests also benefits the Israeli economy in multiple ways. Thank you to Hani from the Tel Aviv Stock Exchange and to Itzik, Ophir, Yaron, and their teams from the ISA, Israel Securities Authority, for your support and help to the industry. In the tax issue, to dearest IHFA member, Mr. Avi Neumann from PwC. Avi, where are you? For his invaluable contribution and assistance to the IHFA throughout the years. On the regulation issues, a big thank you to Mr. Ziv Erez, a board committee member, for his tremendous help. I would also like to extend my thanks to the members of our association who have assisted us throughout the years on various matters helping to enhance the professionalism of our members. Attorney Roy Engel from Barnea for providing us with legal updates from the Cayman Islands together with Gerard from Kerry Olson Law Firm. And to Attorney Ronen Vinograd for his help with accredited investor issues. During the coming year, we expect to continue to advocate for our members and industry in front of policymakers and regulators. Now back to our conference. We are excited to have you all here with us as we have an amazing lineup of panelists and moderators who will cover the most relevant and interesting topics. At this time, I would like to thank all of our panelists and moderators, hedge funds, family office, institutional members, and brokers, and all other participants. A special thanks to Mr. Andrew Abir, Deputy Governor of the Bank of Israel, and two Israeli luminaries, Mr. Chemi Peres and Mr. Izer Shai, who will honor us with a fireside chat discussion how Israel's resilience, optimism, and entrepreneurial spirit will provide for a better world. Thank you to the Tel Aviv Stock Exchange for hosting us today and for your continued support of the hedge fund industry throughout the year. Thank you to Chani, Orna, Liran, Sreya, Yaniv Pagod, Yaniv Savion, Adam, and last but not least, Naor, who manages the conference center for his tireless efforts and help. Thank you. Many thanks to all IHFA board members for your tremendous help and support throughout the years. I couldn't have done it without you. Thank you very much. Thank you for the planning committee who helped me put together this conference, Lior, Max, Nati, Lital, and Dikla. A special thank you to Jeffries. Lior Shimonovich, where are you? One of the founders of the IHFA and a long-standing supporter of the association for your commitment to the IHFA and to the Israeli capital market. Tודה רבה. Finally, this event could not be made without our wonderful sponsors, some of whom have been supporting the IHFA since the very beginning. Adam? Those are our sponsors. Now, as we proceed with our conference, let's focus on what we can do collectively and how we can support each other, both professionally and personally. Together, we will navigate challenging times with the same entrepreneurial spirit, innovation, and resilience that have been the hallmark of Israel. Our thoughts are with all those affected by the current situation, and we hope for better and more peaceful days ahead. I wish you all a meaningful, productive conference. It's my honor to invite Mr. Andrew Abir, Deputy Governor of the Bank of Israel, to provide an overview of the Israeli economy during these times.
Good morning. The only reason I agreed to speak here was when they told me it was going to be in English, which was a big relief for me. And it's probably for you when you understand and if you've heard me speak in Hebrew. What I'm going to try and explain to you over the next 25 minutes is, after 404 days of war, why the Israeli economy has been so resilient. And what are the forces that are going to be there leading us forward. Now, I'm going to show you a lot of graphs. You're going to have to concentrate a little bit during this 25 minutes. But in order to understand how we've weathered the last 404 days, you have to understand how we came into the conflict. What was the situation on October the 6th, 2023? And the bottom line was that the balance sheets of households, corporates, and the government were all in a very good situation on October the 6th. The top left graph shows you the GDP according to its trend growth over the last 5-6 years. And what you see is that when we came out of Corona, we essentially had 8 quarters of growth above the trend line. So on the trend line, when you look over the last sort of 10 years, so when we look at sort of potential growth, it's around 4% of GDP. And I'll talk about that a little bit later. What does that mean in terms of going forward? Is the potential growth still at 4%? And when you look at the right-hand graph in terms of the employment market, these were at levels that were historically high or low, if you think about it. The unemployment rate was around 3%, and the employment rate was at its all-time high level. So that essentially meant the combination of two meant that households were in a decent situation, because it was not just in case of being at full employment, wages had been growing strongly throughout that period as well. The fiscal situation of the government, look at the bottom left-hand graph, which shows the debt to GDP ratio. The achievement there had been that the debt to GDP ratio had gone back down to just below 60% of GDP. That essentially meant that the government had the fiscal space to be able to put out programs without too much concern about how it was going to fund the increased government deficit. And what we saw was that after a spike in the COVID period, when it went back up to 70%, it came very quickly down to 60% in the 2-3 years afterwards. Now, those are very particular years. And you can't extrapolate from that it will be equally easy for us to come back down from 70% to 60% without difficult steps. And I'll come back to it a bit later. Inflation was also, bottom right-hand graph, had come back down, but it reached its peak at the beginning of 2023, got over 5%, but it was coming back down towards the target. So in other words, in all that area, the situation was good in terms of how the economy was going to struggle through the next period. Now, this is a graph that we used to show investors in Israel, foreign investors in Israel, about how the economy bounces back from geopolitical events. And there's a series of geopolitical events here: the Second Intifada, the Second Lebanon War, Operation Cast Lead. Unfortunately, we've had a lot of these events, so there's lots of names about there. But they all had a sort of a common thread, and that was that the economy generally weathered them reasonably well and bounced back very quickly. However, this event, since October the 7th, is very different. This is not like any of those previous events, both in terms of the length of the conflict and its impact on the economy, and its impact on the economy that will carry on even after the war is over. The scarring from this war is going to be far more substantial than it was in previous episodes. And that's just simply because of the scale of the war, the scale of the number of casualties, the number of people wounded, and the impact on Israel's position in the world. And all these things are going to come together and will lead to a lower potential growth over the next 10 years than what we had in the previous 10 years. So it's not going to simply be over simply because the war hopefully ends, let's say, in the first quarter of 2025, of which we still don't know whether that will be the case. The immediate reaction of the markets after October the 7th was as I think we would have expected. October the 7th and 8th, the Saturday and Sunday, we held meetings at the central bank to think about what to do when the markets opened up on the local markets opened up on the Sunday, but the real event was the opening of the exchange rate market on the Monday. What was going to be the situation, and what was the central bank going to do? The first thing that was very clear to us was that we weren't going to cancel it as a business day. There were calls to cancel the Sunday and Monday as business days. But for us, the most important thing was to send out the message that we were still there as business as usual. At the same time, we came out straight away with a package of proposal of measures, both in the foreign exchange market, in the repo market, and various other things that were to essentially to say to people that the central bank would be there to make sure that markets continue to function. Now, if you look at what happened on these, and this slide shows you 3 different markets and what happened on that first day, which is in the red. By the way, we'd seen this already in the Sunday night. On the Sunday night, the Asian markets opened up, and we put bids into the market to see what was going on. So we left bids in the market on that Sunday night just to see what was happening. And those bids got taken out, got taken out at 405. So we knew that the market was going to open up somewhere in the region of 405 on that very first day. When we came out with the program that we would buy up to $30 billion of shekels to support the currency, we already got a sort of a bounce from that initial level. Now, our goal was not to change the price. Markets clearly had to reprice the level of risk in the Israeli economy, and we're not trying to influence that decision. We just want to make that decision happen where markets are functioning. And that was what we were trying to achieve. And more or less that's what happened in those first couple of weeks at the beginning. You'd get the Tel Aviv Stock Exchange was down 7% on the first day, continued to go down to about to 14%, and then we've seen a recovery afterwards. Similarly, the government bond market, you had a spike of 30, 40 basis points in that first day, but again it calmed down. So the initial goal of the monetary policy was to create a calmer situation in the markets. And that was what we were trying to do in that very first period. Afterwards, we start to think about how the economy is going to recover or carry out through the war. Now, in times of volatility, it's very difficult to rely on the normal statistics that's produced by the Lamas, by the Bureau of Statistics, because the lag is just too far. So we're looking for fast data that will give us a pointer of how the economy is weathering the volatility and the conflict. And the one we look at first is the left-hand graph. That's the graph of credit card expenditure, because we get that data with a 2-day delay. So basically we know how the Israeli consumer is behaving almost on a daily frequency. And what you can see, there was understandably a sharp drop in the first quarter of 23, but then a very sharp recovery. Now the recovery was probably more than you've got to be careful about the data here, because it was showing data that's just on the credit card expenditure in the domestic market. It doesn't show expenditure of Israelis using credit cards abroad. Now, what essentially happened was that the Israelis stopped going abroad. They weren't going out on the holidays, and they were compensating themselves in the domestic consumption. So the domestic consumption actually held up very well, partly because some of the income that people normally spend in going abroad was being spent at home. In the unemployment market, the official unemployment rate didn't really change. What you saw was different other statistics that give you an idea, and this is the middle graph, and I'll try and put you through it. So you've got the unemployment rate, which is the bottom area of it, which was still around 3%. Then you have the next part of it. You see the 6.3, which is absent for economic reasons. That's essentially people who were put out on furlough, out onto chalat. So those areas, those companies that could no longer carry on functioning in that initial period, put the workers out on furlough for a short period, and those come into the statistics. Then you've got the people who are on military reserve duty. That's the dark blue, the 3.1%, and that slowly comes down. And then you've got the 7.8%. The 7.8% is people who are missing from the workforce for non-economic reasons. And you can basically summarize that in 2 words: the educational system. If the schools are shut, people don't come into work. And that was the crucial event in the first quarter, the fact that schools were shut. As soon as the schools came back online, people came back into work. And then you see, as the war carries on, all those columns start to sort of go back to the normal thing. And now we're left where we're basically in August, which is the last data we have. I'm not sure the September's out. You're talking about around 4% of people who aren't working. Either it be from the unofficial unemployment, military reserves, or a little bit of furlough. It's not catching the expansion of the war down to Haifa now. Those figures will change. And they'll change, and the real question is, if the war carries on, does it shut down the educational system in the northern part of the country? Because that will be a major change in the economic prospects of the next quarter or so. Another factor that gave resilience to the Israeli economy was that in terms of its international investment position, Israel was in a very good shape. The right-hand graph is showing, we call it the basic balance. The basic balance is essentially the current account surplus plus net FDI. It's showing flows that are longer term in nature, not flows into the equity market or into the bond market. And what you see is that the current account, which is the orange line, has continued to be very strong throughout the year of war. The FDI has dropped, but has been compensated by that strong current account surplus. So we still have a very strong flow of money that's coming in, basically propping up the shekel. On the other side, the flip side is that the net asset position of the country is very strongly positive. And that's because we have excess savings. So the institutional investors are having to buy assets abroad because there's simply not enough assets in the local market. That's a very different position if we'd been in the flip side of it and we'd been reliant on foreign investors to buy domestic assets. And we weren't in that situation. Having said that, all that, there are 2 sectors in the economy that basically took the biggest hit during the war. The first one, I don't have a graph for that, but I don't need a graph for that, is the tourist industry. Tourist industry is finished in terms of foreign tourists. You're not going to see foreign tourists come back for 2-3 years. So you can essentially say that industry has gone, or that source of income in terms of the hotels and whatever, and it's not going to come back very quickly. The second one, and it's a bigger industry, is the construction industry. The construction industry is around 8% of the economy. Now, the left-hand graph, which I think is the important graph, shows the workers in the construction industry between the 3 groups of workers there. The main group is Israelis. That's the 203,000 workers that were in September 2023 on the left-hand side. Add to that the yellow bar, which is the Palestinian workers from the West Bank, that's 72,000 workers. Add 40,000 illegal Palestinian workers, you're getting to around 1/3 of the workforce was essentially cut off from the construction industry. Foreign workers, 26,000. Essentially what's happened is that the construction industries are missing 1/3 of its workforce. So if you think about it just in terms of simple back-of-the-envelope statistics, if it's 8% of the economy, you're missing 1/3 of your workers, you've had a hit of around 2.5% of the GDP of the economy. And that's something that we're seeing in the figures. The real question is, how do you make up for that shortage in workers? The government thought about bringing in foreign workers. You can see from the bottom line, it hasn't budged at all. There hasn't been an increase in foreign workers coming into the construction industry. And it's not just, and it's partly because the workers that they need are, to make up for the Palestinian workers, are highly skilled workers. Now, those highly skilled workers can work in construction industries anywhere in the world. Do they want to come to a war area to work? Not so sure. So that still remains one of the main challenges, what to do in terms of the construction industry, and continues to put a supply shock on the economy. Translate that into housing prices on the right-hand side graph, and that more or less explains why housing prices have started to go up again. Because people understand that there's a shortage, there's a supply shock, there's going to be a shortage of housing over the short to medium term, and they're translating that into action. And you see more people going into the market, mortgages are up. Just think about it. People are prepared to make the largest investment decision of their lives in the middle of the war. Now, I was stunned by that. I thought people would be far more reticent to go back into the housing market. But it shows the amount of faith that people have in the Israeli economy. When my daughter, who's now looking for an apartment in Tel Aviv, came to say that she's looking to buy a place, I was very surprised. But it does say something about what's going on in terms of I didn't say anything to her, by the way. I hope she's not listening into the recording of this. But that does show how people are reacting to the war. You can see it also, the resilience of the economy, also in tax revenues. So tax revenues have gone back up to their trend line in both direct taxes and indirect taxes. And this is a very good indicator of economic activity. This is more or less, along with the credit cards, our best indicator of how the actual economic activity is recovering throughout the war. And it's back towards the trend line. Similarly with exports, we're seeing a reasonably strong performance on exports. There has been a recovery both in goods and services. In goods, it was more in terms of prices rather than in quantity. But when you look at exports, the service industry, which is the main one, which is includes the high-tech, yes, it's recovered, but you can see it's fairly flat now for the last couple of years. So that it is raising some question marks about the export industry and how it's going through this period. So it's still doing reasonably well, but it's not doing as well as in previous periods. Credit. There's no problem in terms of companies getting credits. Even in ones that are usually more susceptible, which are the tiny business and small businesses, they're still doing reasonably okay. And the Bank of Israel encouraged the banks to put out various programs to help these companies and to help people who are affected by the war. But we're actually seeing a pretty healthy credit situation in terms of the availability of credit. And when you look at the various questionnaires that are given and trying to see where the limitations are, credit isn't a limitation on people's activity, neither in the household sector or in the corporate sector. The high-tech sector, which is probably the main engine to growth in the economy, has also weathered the war relatively well. So if you look at the left-hand graph, which is the revenue of high-tech companies, the exports of the high-tech sector, or the number of people employed, it's holding up. It's not stellar growth. So you're going to see a come down on the amount of growth in the economy because the high-tech sector is doing okay, but it's not doing as well as it was in the previous periods. And if you look at the right-hand graph in terms of employment, it's more or less peaked at 380,000. And that's not because there isn't a demand for the workers, there just aren't the workers. And that leads me back to a long-term challenge, which is how to get more people who have the skills to work in the high-tech sector. That's not connected to the war. That's connected to our education system, which is failing our children. So when you look at the skills that our next generation have, we have a very good top 20% of the population. But when you look at the bottom 40%, they do much worse than their parallel groups in other OECD countries. Now that's not just the Haredim, that's not just the ultra-Orthodox, it's throughout the educational system. We aren't training the next generation of children, your children, my grandchildren, to succeed in the world that will be there when they come into the employment market in another 20 years' time. And that's a major challenge. When you look at the fundraising by high-tech companies, it more or less follows what went on in the rest of the world. You had that amazing period in 21 when high-tech companies were managing to raise capital at record levels. It came down there, and it stayed low. And this isn't something that's unique to Israel. It's actually, you can see it when you look at the high-tech sector in most other countries in the world. The good news is that we're seeing in the last couple of quarters, something of a recovery. You can see that in the last two bars there. It doesn't look tremendous, but you're comparing it to the 21 period. You really need to compare it to 2020. So we're still off the 2020 period. Some recovery, but definite question marks about there, and I'll come back to that. I'm not going to say anything about too much inflation, which is strange for a central banker, but I want to talk things that maybe they're more interesting to you. The one thing I will say about inflation is, after having got it back down into the target of 1 to 3%, the supply side shocks as the war is carried on have pushed inflation back up above our target. And we've been clear at the central bank that we are committed to our inflation target. And we're not going to be lowering interest rates unless we're convinced that inflation is going to come back into our target. And if need be, we'll raise interest rates if we think we're losing control of inflation. Because the key thing to us is to remain the confidence that people have that inflation will come back to the 2%, the 1 to 3% level. And that's our main mandate, and we will carry that out. I want to just say a couple of words around markets to conclude, because they've put the 2-minute hook sign up for me. Now, there's been a repricing of Israel's risk. And you can see that either in the CDS spreads, you're probably all very familiar with this, that went up. I think this hasn't been updated. It's come down a little bit since the elections and since the most recent escalation between Israel and Iran. But there's been a repricing of risks. The CDS went up to around 180 basis points. The spread between the 10-year dollar bond of Israel and the US Treasury went up to 174. It basically prices us as a low BBB country. What we've seen over the last couple of months is that there is some form of optimism that in the markets, and I think it's about the optimism about how the war is going to play out, that has been reflected in essentially a reduction in the risk premia, a reduction in the spread to the US, both in dollar bonds and in shekel bonds. I'm not going to say whether the market's getting ahead of itself or the market's pricing it incorrectly. That's certainly not my job. But we are seeing a reduction in those risk premia. I will, however, say one thing as we go forward. Risk premia, even if the war ends, will not come back down to the levels that we saw before the war. They will come down. You'll see the shekel strengthening. There'll be a flow of money coming into it. But we won't come back down to where we were before, simply because the position of Israel in the world has changed. And investors will require a higher expected return to invest in an Israeli asset than before the war. You can think about that in terms of equity, you can think about that in terms of bonds, and you can think of that about in terms of let's take a European company that's thinking of acquiring a Israeli company, it's going to need a higher expected return than it would have beforehand to compensate for the hassle and the noise connected to investing in an Israeli company. That is the reality we will face even when the war ends. And we have to be aware of that and to think about what are the implications of that, and for policymakers to take that into account. And that also means in terms of the deficit of the fiscal position of the government. It's not going to be a post-corona period. It's not going to magically come back down again. The government is going to have to take painful steps to get its fiscal position back into a better situation, to get the debt to GDP ratio back down towards the 60% level. We've seen it partially in the 25 budget that's been proposed by the government, and I think the framework of that budget is good. But the components of the budget are very worrying, because the components are not, they've cut things that aren't really, or they rather haven't cut the things that have no real impact, a positive impact on growth. And as we go forward, the long-term planning is going to become more and more important. It's not just a question of getting the budget deficit down, first of all to 4.3% and then further down. It's also about how that the constituents of the budget, how much of those are aimed at creating growth, at giving incentives to people to work, and reducing the disincentive to work. Now, that's the thought I want to leave you with. The economy has been remarkably resilient as we've gone through the war, but the real challenge is 5 years ahead. Thank you very much.
I see a lot of friends out here, and so some of you know me already. I arrived from New York. It's so great to be back in Israel and to see all of you here today. I can't tell you, זה מאוד מרגש to see all of the faces and the resiliency and just the expertise that you have here in Israel. It's just been a pleasure to visit everybody. I've spent the last 2 days doing that and then working until 2 a.m. because things are busy in the United States as well. So as some of you know, my name's Max Karpel. I'm a partner at Aiken Gump. It's a law firm in New York, and I've been part of the association from the very beginning. So again, it's just very touching and exciting to be here today with all of you. I won't spend time thanking everybody again, but it's been a pleasure to work on this year's conference with an amazing team and to be part of the board. I'm the only non-Israeli on the board. So as I said before, I work out of New York, and it's a privilege to be a part of Aiken Gump, which is the only law firm, the only global law firm that's focused on private funds and is committed to the startup market in the hedge fund space. And that's what I do. I work with startup hedge fund managers and what's really called emerging managers. That's funds from about the zero. Really, these days it's a little bit higher than zero when you're a startup, but from that range up to $1 billion, and even being out of the gate for up to 5 years. And the reason I keep mentioning the global aspect here is because the trend that I'm seeing in the world is a thirst for talent. In the US, there's a feeling that we've hit the ceiling in terms of talent, and more money, just as here, more money flows into pensions, and there's a need to deploy that capital. And for the first time, I've seen it, that the hedge fund industry, the LPs, the investors, are looking for talent. They're looking for opportunities beyond the United States, beyond the UK. So that's why we have offices from New York to London to Singapore, to 2 offices now in UAE, Abu Dhabi, and Dubai. We're opening an office in Saudi. That's where the investors are, and there's even managers there too. And for the first time also, I'm not hearing people say, when I say I'm going to Israel for a hedge funds conference, there's no question mark over that anymore. That is not a question mark, not just because of the growth that's been here, and you'll hear from Ariel in a second, and that's very exciting, but also because this is an amazing time in the world of hedge funds where it's become a truly global industry. So I want to say that this is the time for you guys, for the Israeli hedge fund industry, to take advantage, despite everything that's going on, take advantage of the innovation here, the resilience here, and take advantage of this global demand for your services. So let's hear from Ariel Bino about what's happening here. And I just really want to encourage everybody, despite everything that's going on in the world, take advantage of this moment. Thank you.
Hello, everyone. I'm happy to share with you the results of the 2024 survey of Israeli hedge funds. I'd first of all like to thank all the funds who participated in the survey. It's a lot of work, and as we have more and more funds in the industry, it takes us longer to prepare. And especially also I would like to thank the service providers, the administrators, Apex, Tsur, BDO, NAV, for also helping us with the survey. Let's start with the industry assets. Frankly, I have to admit that when I saw this number, I was surprised. We were expecting to see maybe assets down for the year or flat, but what we see in 2024 is 26% rise in assets of Israeli hedge funds to a record $21.9 billion. This year, for the first time, we break it down into liquid and illiquid assets. In the survey, we don't count private equity or locked products, but we do include illiquid debt, which used to be a small segment, but has grown tremendously in the last couple of years, and has grown just 53% in the last year to $8.9 billion US dollars. But we also see growth in the liquid asset side. Most of this is actually from price appreciation this year. But we have 16% growth to $13 billion US dollars on the liquid asset side. In terms of number of funds and number of managers, so we counted this year 299. So next year, hopefully over 300 hedge funds. Managed by 199 fund managers. If I divided it between liquid assets and illiquid, so we have 238 funds running liquid strategies and 61 private debt. Taking a long-term view, we've been aggregating data on the Israeli hedge fund industry since 2007. But here you can see growth in assets from 2011. And the growth in the industry has been 20% a year aggregated. I think many investors, if you could invest in the index of number of Israeli hedge funds, you would have done well, or in terms of assets in the industry. Okay. Industry employment, we've crossed the 1,000 employee line. This is our estimate, 870 investment professionals and 470 support professionals. This is only in hedge funds directly. It's without all the service providers, without administrators that surround that. Average assets per fund has stayed pretty much the same as it was last year, around 73 million US dollars. 10 largest funds manage 7.5 billion. And we have 35 funds that we counted with assets over 100 million. Looking at the liquid strategies, the largest category continues to be Israeli equities, with a share of about 40%. This is in terms of assets under management. And we'll touch in a couple of minutes on performance. This is also where we see best performance over time and the most alpha generated. So for a good reason, I think many investors gravitate towards that strategy. The second class is multi-strategy. That has also been a successful strategy that has grown. 20%, around 20% fixed income. In terms of assets under management, about 12% has gone to global strategies, and this has grown in the last year with private investors shifting money outside of Israel, but still remains in terms of assets under management a small part of the industry. And the rest, 6%, is other strategies. In terms of number of funds, so we see a similar picture, but one thing that stands out is that global equity funds, in terms of number of funds, represents a larger share, around a quarter of the industry. So what that tells us that global strategies, we have a lot of funds in Israel, but they tend to be smaller. Let's talk a little bit about performance. I think this is what's driven the growth in the industry that we've seen in the last decade or more. We see the TGI, Israeli Hedge Fund Index, significantly outperforming the local markets. In aggregate, since 2007, performance has been 360% compared to 128% for the Tel Aviv 125. Or around 90% for the All Bond Index. One thing that you can see in the graph, thank you. One thing that you can see in the graph is that while the Israeli hedge funds have been correlated, you can see that there is correlation to the local market, but a lot of alpha generated. So I think when people talk about what are the objective functions for hedge funds, so it could be low correlation or it could be alpha. What we see in Israel is mainly alpha generation as a reason for the existence of hedge funds, and they've done so tremendously. Looking at, this is kind of average numbers, standard deviation for the average for Israeli hedge funds, 6.8%. It's about half the standard deviation for the Tel Aviv 125, while being higher than bonds. And I think when we look at Sharpe ratio, which is performance to risk taken, this is where you see the outperformance. So overall, since 2007, Sharpe ratio for the average Israeli hedge fund has been 1.1 compared to 0.3 for the Tel Aviv 125 and 0.5 for the Israeli All Bond Index. Here you can see performance divided by different strategies. Solid performance, surprising relative to everything that's been going on in Israel in 23 and 24. Relatively solid performance across the board, where we see the best performance actually Israeli equity. We see also very strong performance in global equity, but the Sharpes there are lower. Highest Sharpe in the general index, 1.0, and for Israeli equity, 1.1. If we look a little bit deeper under the hood, looking at where Israelis are invested through hedge funds, so about 70% of the money is invested in the local markets. This includes the illiquid strategies, and 30%, around 31% in global strategies. Looking at share of investors, and this number has also been pretty stable in the last couple of surveys. So most of the money coming into Israeli hedge funds continues to be private money. Institutional investors count for about 30% of the AUM, private investors around 70%. Looking at Israeli versus foreign investors, so Israelis are a large majority, 81% of the assets. We do have 20% of the assets in Israeli hedge funds coming from abroad. Hopefully, we see this number growing in the coming years. And that concludes the results of the survey. Thank you very much.
Good morning, everyone. My name is Boaz Warshavsky. I'm the CEO of Objective. First and foremost, I would like to thank Ms. Natalie Raz for organizing this insightful conference and for the incredible work she does throughout the year. Before we start our next panel, I would like to talk about Objective. Objective is a company that performs pre-investment analysis and ongoing monitoring on alternative investments. The field of alternative investment is rapidly expanding in Israel, and we can see an increase in investment from both institutionals and private investors, as we just saw in the data that Ariel just showed us. As a result of that, there are many funds that are raising capital in Israel. However, since the analysis of alternative investment is complex compared to the public investments, many investors face difficulties in conducting due diligence on funds. This complexity often leads them to avoid investing in the fund, fortunately. This is the reason I decided to establish Objective 6 years ago. Our service allows investors to order a pre-investment analysis on any type of alternative investments, including hedge fund, real estate, private equity, credit, and more. We also provide ongoing monitoring that include an annual analysis if they decide to invest in the funds. It is important to note that our analysis is not an investment recommendation. Our goal is to provide the investor with comprehensive information about the fund, allowing them to make an informed investment decision. So far, we have analyzed over 130 alternative funds of all types from Israel and around the world. Finally, I would like to invite our distinguished panel of experts who will share their knowledge and perspective on the hedge fund industry for the year ahead. Thank you all for being here, and let's get started.
Great. Lior Shimonovich, Head of Israel Equity Sales for Jefferies. We are very, very much committed to Israel. We have an office here. We have 12 people at Jefferies who are dedicated to Israel across investment banking, equities, fixed income, and wealth management. We're very proud of the fact that our managers, shortly after October 7th, decided very quickly to dedicate a trading day to aid organizations in Israel, and we raised $13.4 million on October 10th. Our CEO has been here a number of times. We host the largest annual investor tech conference called Tech Trek every year, and we're very, very proud of the support that our entire franchise and our team have given us. So thank you all to our friends and partners and trusted advisors. I guess with that, we'll do some intros on the panel and then jump into questions. Daniel, do you want to start?
Yes, sure. So Nathaniel Dreyfus from Eden Alpha. We manage 2 hedge funds, then mostly global, and 1 a VC fund. So we are active in the public and private market. We work since 2012. We are active in the hedge fund industry. We are on the road to open a 3rd fund. And we're a team, we come from engineering background, and we are one of the most, one of the first hedge fund in Israel, one of the initial fund in Israel.
Okay, good morning everyone. Thanks for having me here. My name is Tamir Gluska. I'm the managing partner of Kai Capital. Kai is a global equity hedge fund, investing partly in Israel, but mostly abroad. And we are a classic Buffett-style value investors. So we look for excellent companies that are, for some reason, very, very cheap. The fund has been around for 10 years. I've been managing it since inception. And what makes us a little bit different or unique is that in our DNA, we are a combination of technological and engineering, let's say, expertise with financial analysis. So we are a team of 8 people, half of whom are engineer and ex-8200 and tech guys. The other half is financial analysts. And that way, that helps us dive deeper into the technical aspects of the companies we invest in. So that's the one thing we do. this hedge fund, Kai Capital, and happy to be here and answer the questions.
Hi everyone, I'm Josh Lippman from Sphera Fund. As you might have guessed from my accent, I'm originally from London. I started my career at PwC and then in equity research at Citibank. 11 years ago, I made the best decision of my life to make Aliyah, moved to Israel, or if my wife said, tell her the second best decision of my life. I'm currently head of research at Sphera Fund. Sphera is one of the oldest and largest hedge funds in Israel. We have over $1.5 billion assets under management, primarily focused on equities, both Israel, global tech, and healthcare. And yeah, that's me.
Hi, Ariel Sternberg with Community Fund. We spun out of Your Capital 4 years ago. We manage just over $500 million. We invest across the capital structure, meaning debt and equity, in public companies and private companies. Our preference is always for credit, preferably senior secured credit, strategic assets, cash flowing assets, ideally low multiples, and we keep a very active approach, meaning always we communicate with management teams, owners, Jeffries. That's it.
Thank you very much, everybody. I think the first question will be very relevant for Israel specifically, and I'll kind of point to everybody to give a minute maybe to respond. But as we see the shift from active to passive, especially through ETFs and globally, and it's obviously recently ramped up here in Israel, would love to hear from each of you on what you think the role that active should have in your portfolio and how allocators and investors should think about it.
Yes, so thank you for the question. Interesting. Actually, it's a long trend, and when we speak about passive investment and investing in ETF, basically, we should ask ourselves to which market do we refer. If you look at the global market, for instance, if you invested, I looked at the return of the market from 10 years ago, yesterday, 10 years ago, and you look at the return in Hong Kong, the return is minus 2.2. If you look in FTSE, it's 2.2 per year of return. In Israel, it's 8.8, and the outlier in the world is the USA, the S&P 500, mainly due to the NASDAQ companies. So the return, when people are drawn to the passive investment, they are looking at basically the S&P when they're talking about it. So we need and it's not so easy because there are some lost decade. If you look at the history in those of investing in those ETF, you can see that for more than 10 years you don't have any return. It's something very lonely, very difficult. Basically, what I will make it short, but it seemed very easy. It seemed the right thing in theory, but in practical, human beings are human beings, and most people do not invest in passive investment. They trade around passive investment, and if at one point you sold your stock because the corona, you sold the ETF because crisis I don't know, in Russia or in Israel. So you are basically becoming an active investor through passive instrument. So it's, in theory, quite easy. People should do it. In practice, human beings are human beings. And most of the time when people don't have the return of those index funds, and through an active management and also active investor investing, you can pass through those hard time, and you know that you have someone that will bring you to the other side, and you will enjoy the return of the market.
I think I might expand on your answer. So first of all, it's noteworthy that in 2024 in the US, for the first time in history, there is more money in passive funds than in active funds. So it equaled, right, this year. And what I would say to allocators is that the more popular passive investing becomes, the more risky it becomes. So I'll say that again. The more people invest passively, the bigger the risks for those investors, and why. So when you invest actively, if you buy, let's say you pick a stock, so even if you don't do the entire analysis, you must be aware of the fundamentals. So you know what the company is doing, what the product is doing, whatever. When an investor buys an ETF, invests passively, so that decision tends to be disconnected from the fundamentals. So he says, okay, everyone are buying the S&P or Tel Aviv and making money, so I want to join the party. Or I think the index is going to go up, I want to invest in it. And well, it's not, typically an investor would not value each stock in the index and try to see how much it's worth and then make a decision. So he makes a decision on other factors, and those decisions tend to be more susceptible to herd mentality and irrational behavior. Now, when the market goes up, everything is fine. Now, let's assume the mood in the market changes and everything goes down 20%. And I know it sounds hard to say, but at some point it's going to happen. So we're going to have a year sometime soon when the market's going to go 20% down. Now, the active investor, he has his fundamentals, so he knows when to buy and sell. The passive investor, who just sees everything going down 20%, he doesn't know what to do. So he's much more prone to making mistakes, same as you said, like buying at the wrong time, selling at the wrong time, becoming an active investor in passive funds. So, and the more people do it, the more that volatility increases. So the more the market swings around the fundamental value. So what I would claim is the more popular it becomes, the more opportunities passive investors have to make mistakes. And ironically, it makes it more attractive for the active investors. So I would guess the next 10 years, the active funds, I'm preaching to the choir here, but the active world is gonna come back and beat the passive one.
Hi. I think I would add 2 points. The first is obviously the attraction of uncorrelated returns or less correlated returns. Obviously, when the market's at its highs, people are less worried or interested in that, but there is definitely, or there should be room in everyone's allocation for some active management that can provide some protection through the use of hedging, concentration, etc., that you could have uncorrelated returns to the broader markets in drawdowns. I think the second point, which is maybe more relevant to Israel, is typically the less sophisticated a market, the better the opportunities for stock picking, because there's a lot of price discovery that you can achieve that others haven't. And in Israel, where typically there might be less liquidity, there's probably less shorting in the index as a whole because of the large kind of institutional investors. There's often that dislocation between price and fundamentals in companies that offer opportunities for active management. When you roll on ETFs on the top and people are kind of following the herd, that just magnifies those dislocations. And so you get these kind of bigger differences between the underlying fundamentals of a company and the share prices. And so following what Tamir said, I think that can provide a ripe opportunity for active management to really come and select those better stocks and actually outperform over time.
So I'm not sure which one outperformed the other asset class. Obviously, active investing, as an investor, you have more information, so you should be able to deliver better results. Does it compensate for the additional fees and illiquidity that comes with investing in a fund? I don't know.
Josh, one for you. Can you talk about the risk of owning big tech companies, or in particular the Mag 7 versus a more diversified set of perhaps smaller companies?
Sure. So obviously the Mag 7 are some of the best companies in the world. They are exposed to some of the best secular trends in the world. They have probably the best management teams in the world. And many of them are at pretty reasonable valuations. I think it's important to highlight two issues with fully owning just Mag 7. The first is that the biggest risk for the Mag 7 companies is regulation. It's pretty hard to predict where that's going to go because it's very dependent on personalities. So I think if you only own a basket of Mag 7 and the regulatory environment took a turn for the worse, you would have a bit of a problem on your hands. But I think the second more fundamental way to look at it might be to, if you look at the last kind of, or history as an example, the largest companies often don't outperform over the next kind of 10 years. And the reason is that the largest companies attract competition and struggle with what's called the innovator's dilemma. It's very difficult for them to invest in the new, exciting areas because there's a risk that that will cannibalize their existing profit pools. And so we've seen that in the past. I mean, you can look at a company like Intel, which was running the world, brilliant, brilliant company, had lots of competitive moats, but ultimately was unable to invest in the right areas because of its business model and got overtaken. So the Mag 7 right now stand far and away as the best businesses out there. For each one of them, I could come up with a reason why they might struggle in the future from this innovator's dilemma. I'm not sure most of them will. But I think that it's something to be aware of, that just because they're the biggest and the best right now doesn't mean that that will be the future.
Thank you. Nathaniel, can you talk a little bit, and dovetailing off of that, the opportunities in small caps in particular?
Sure. So first, for the sake of the discussion here, let's define small cap. It's company until 10 billion USD market. Historically, the small cap overperformed the large cap historically. But in the last 10 years, we see a different, the large cap overperform significantly the small cap company. And basically, we saw it in our day-to-day life. We saw a tremendous rise in a technological company that went from tens of billions of dollars to several trillion of dollars in less than a decade. It's something phenomenal. We are living a revolution. So this is the reason that, most of the reason that we saw in the last 10 years, the overperformance of the large cap, and because in the large cap you have some of the best company, but we need to be aware that tree doesn't grow to the sky. They have their limit, and the large cap also have a tendency to plateau. And if you look at the small cap versus large cap, this is also a cyclical event. And if you look at the history, you have a lot of period that the small cap overperformed. So now, the question is, what will be the next decade? Let's say, if what will be the next 10 years, and in which part of the market you will have the opportunity. We are now in a cycle of lowering the interest rate, which is quite good for a small company. Large company in higher interest rate tend to do better because they have easier access to the capital market and so on. Smaller company is more tough for them. So now that we are lowering the interest rate, it's something that should be a tailwind for those companies. They are also, if you look at the US with the election of Trump and America First, and this should be also beneficial for those companies. And so the smaller companies are at a discount, historical discount. But you need to, it's very different because in big company you have the flow of the ETF that help you. You don't have to be right. You have to be right on a sector. While when you invest in a small company, it's more a bottom-up approach. You don't need to look at the sector. It's very company-specific approach. And there you, especially that in the last 10 years, you said that most of the money is managed through passive instrument. You have very little coverage of the small company industry. The big bank doesn't coverage that very well. So the importance is the analysis in those company. As an index, they are trading at lower PE compared to the large index. But if you are right, if you find a company that you do the research and you invest in the right company, you can be rewarded very highly. You can have very high return in those companies. Now, I think the opportunity, if you see right now, the small market is rising in the US, but the US is drawing a lot of money from all over the world. And maybe the opportunity for next year will be to look on the small cap company, but not necessarily in the US, but from where the company is drawn. If you look at Europe, for instance, right now you have the US is going up, the Europe is going down because the money goes out, and you have the opportunity to invest in tremendous company, exceptional company in Europe with very good fundamental and at very reasonable prices right now. So you can use this opportunity that the frenzy of the election to build a position to be well positioned for next year. Thank you.
On that point, Tamir, multiples. Let's talk about multiples in the S&P, where you see them historically, and where you might go.
Yeah. So as maybe a case to close the case for the small cap. So the PE multiple of the Russell 2000 is about 16, which is the long-term average. S&P is about 31, which is double the average. So their average is the same. And but I would look today or always at what we call the cyclically adjusted PE. So that's the 10-year PE. Some people call it the Shiller PE. He was the first to institute it. So we take the profits of the last 10 years, right, and we divide the price today of in the average profit of the last 10 years. So the Shiller PE of the S&P 500 is 38.2, I think, this morning, which is almost the historic record. So does anyone have a guess which was the actual historic record? At what point in time? So it was, 2000 was November 1999. So November, just before the 2000 internet bubble. So the Shiller PE was 38. And right now it's 38.2. So we're at an all-time high. And let me remind you that the following the 2000 bubble, the market went down 50%. So now we start, with the usual explanations or excuses, depending who you are, that the world is different today. We have the AI changing the world. We have everything is more technological. The market is used to high multiples and whatnot. So I don't know if the market's going to go down 50%, but let me just leave you with this thought. So the internet revolution of the 2000s was not enough to justify a multiple of 38, because the market went down 50% afterwards. So does the current revolution, for the first time in history, does justify such a multiple? I don't know. I'm guessing we'll find out in the next few years. But let's say the answer is yes, so it will be the first time in history that that happens, so that the profit grows that fast to justify such a multiple. So we'll all find out.
Thank you. Switching gears a bit, Ariel, your fund's Israel and Israel-related. Can you talk to us a little bit about what opportunities and how you think about investing in Israel today?
Sure. On the public space, we think it's very difficult to find securities that are priced reasonably. It all looks too expensive to us, both publicly traded bonds in Israel and publicly traded equities. Where we do see opportunities recently are basically the result of the war. So most recently, over the past few months or year, we've been collecting Leviathan bonds. We think they're a very low LTV, very strategic asset. If it gets hit by a rocket or anything, the value is there. It's protected, 10% yield, trading at 90 at the time, whatever. One opportunity, we saw another such opportunity on the equity side of another northern-based energy-related company. But it's very difficult to find cheap public securities in our minds. Where I do think there is an opportunity right now is more in the private space, mostly in the large, very large assets that are private, because historically you would see large US institutional investors coming here and buying Phoenix, buying Bezek, buying other such companies. These guys are not gonna write a big check, and if they do, it's gonna be to a very high yield. So I think if you can put together, there are some interesting assets right now on the shelf where I think there's opportunity.
I think I might know a bank or two that might be able to do that. Tamir, we'll wrap up with you. Let's talk about the Israeli financial sector, specifically the banks, the insurance companies, the credit card companies, how they've withstood the conflict so far, and how you see that going forward.
At the beginning of the war, so we kind of expected to see a debt crisis in Israel, both in the banks and in the the private credit companies. We thought, everyone are going to Miluim, some businesses are struggling. There's going to be a debt crisis to some extent, and that did not happen. So I would say so far so good. The banks are at record profits. The private companies, the good ones, are as well. So as I was saying, so far so good. Looking forward, I think there is an interesting dynamic developing right now, because most of the Israeli, or I don't know if most, but a very large part of the Israeli credit market is dependent on real estate, residential real estate specifically, both on the company side and the consumer side, the mortgages. And while real estate prices did not go down over the last year, as I'm guessing we all know, what is happening today is that people are buying apartments with a very small down payment, like 10% or 20%, with the rest going at the end. So I would guess that in a few years, we're going to have a lot of people having to put, the entire payment for the apartment that they bought in 2024. And many of those people did not even plan to have that money there. So on the other side, demand here for real estate is always strong and remains strong. So, but I think that's an interesting dynamic that we would follow. So any crisis, or even an apparent crisis, so that it seems that many people cannot afford the apartment that they bought a few years ago, might cause some distress or temporary distress in the financial system. We'll have to live and see, and we'll have to follow that. So I don't know yet. I wouldn't say that it's going to happen, but I say it's a very, very interesting dynamic to follow over the next year or two.
Thank you very much to our panelists and all of you for listening. Thank you.
Good morning. I am Manish Rao, Senior Vice President at NAV Fund Services, and I'm very pleased to join you today. I'm with NAV from last 18 years. In evaluating Israel as a potential location, we found a market ideally positioned to support an increasing demand for experienced administrative services due to a resurgent local economy, increased international business presence, and rapid growth in the alternative fund management industry in recent years. We have adapted our operational processes to Israel market requirements, and despite recent instability, we continue to see huge potential and look forward to partnering with Israel fund managers in support of the continued growth and development of the local fund management industry. A little bit about NAV Fund Services. NAV is privately owned and has achieved more than 30 years of year-over-year growth, maintaining a 99% client retention rate. Ranked number 1 in an independent survey of industry CEOs, we are proud of our strong reputation for innovative fund administration technology solutions and best-in-class client support. NAV is among the top 10 global hedge fund administrators by number of funds, servicing more than $310 billion AUA for 2,300 clients worldwide. The NAV team of 3,100 professionals offers expertise in fund administration, compliance, security, IT, and accounting disciplines. NAV utilizes our own proprietary fund administration technology to support every fund structure and asset class traded. This strategy eliminates third-party software costs and time spent integrating outside technology, enabling us to offer comprehensive and flexible solutions at an excellent cost for value. The company is headquartered in the United States with 8 facilities in India and locations in Australia, Cayman Islands, Ireland, Mauritius, Philippines, and Singapore, plus the ability to service clients domiciled in multiple additional countries around the globe. Thanks for providing us the opportunity to speak about NAV. Enjoy a wonderful day.
It's my honor to invite Mr. Chemi Perez and Mr. Izar Shai for a fascinating fireside chat. Please.
Hello, Chemi.
Hello, Izar.
Nice meeting you. Do we speak in English? That's it. All right. So, I'm not sure if you're here, Chemi. I attended the last session about half an hour ago. I think that the spirit was quite optimistic for all kinds of reasons which I do not understand because I do not come from this market. Are you optimistic these days?
I'm actually optimistic all my life.
Well,
because my father, as you know, said that optimists and pessimists die the same way, but they live different lives. And it's better to live as an optimist. And being an optimist is not being naive. I think it's a way of approaching life. It's always a call for action, because if you believe that the future can be shaped and can be good, then you act. If you're a pessimist, you may say, no matter what I do, it's not going to help. So I think optimists are much more active. And as we say, there's no pessimist to discover a star in the sky, because all the time their eyes are on the floor. So I'm optimistic, but I'm also realist. And I'm optimistic because I believe that we have an amazing people in Israel. Not to mention the government, without getting into politics, but I think that we have an amazing people, and they want to be united, and they want to move forward, and they want to end the war, they want to get the hostages back, and they want to continue and build Israel. And when I see these people, and some of them are here also in this room, I'm very optimistic. How about you?
Yeah, so I share the optimism. You know, you and I are coming from a different investment perspective. We always have been, I mean, I don't want to opine, but we are coming from a world where you invest in early stage ideas, early stage situations. So by nature, you have to be optimistic. This is totally against any kind of fundamental instinct to go give money to a company that almost doesn't exist. Trust a couple of entrepreneurs and build your trust with them over the years. So we are coming from that background. And I believe that coming from there, first of all, your nature has to be optimistic. Sometimes you have to meet reality, but that's a different story. But I'm really looking at what happens here ever since October 7th. And, you know, amidst all the pain and everything that is happening around us, you know, you tell me, but what I see is entrepreneurs coming back from the battlefield and figuring out new companies, new ideas, new ventures. I think that the interesting phenomena that we are watching these days is that young people are coming back and they want to do something meaningful in the rest of their lives, which is an interesting notion that I've seen time and time again. So you see them, they have experienced whatever they have endured the war, and they want to have an impact on what is going on here, and some of them hopefully will go to politics, to the public arena and so on, but many of them want to create impactful ventures, and so they are figuring out big ideas, big ventures. They are as motivated and as aggressive as they had been before October 7th, but they are more focused, and I think that on that end, we can be optimistic. Another interesting point, which I don't know if you saw this, but we saw the numbers of the third quarter, which just came out, I think, last week, of investments in the Israeli high tech. So Q1 through Q3 of 2024 are already higher than the whole year of 2023 in terms of investments in the Israeli high tech. As we all know, most of this comes from the outside, which means that international foreign investors again express their support and belief in the Israeli high tech. So that's another reason for optimism. And yeah, I think that we are also seeing a move of many very good people who are supportive of all kinds of changes in our country. So that also gives you some reason for hope. Yeah, so I am optimistic to your question, yes.
When I see ZAR, and especially when I think about next October, the amazing project that you and your family started, I'm becoming even more optimistic. But I asked to put a slide. I don't know if we have the slide. Usually we don't use slides, but I prepared one to show you.
You're going to talk about animals. Wonderful.
Yeah, all of you are in the investment era. And before we talk about next October, I want to connect to what you said about the CEOs coming back from the battlefield. We have many of them. Many of them have been experiencing very tough situations during October 7th and later on. And the motivation to build companies and to grow them is unprecedented to what we've seen in previous years. I put that slide. Just want to show my optimistic view about the Israeli high tech. What you can see here is actually you can see a giraffe, you can see a kangaroo, and you can see a unicorn. A unicorn is a company that reached a market cap or a valuation of $1 billion. That was a dream for many Israeli entrepreneurs before October 7th. And in 2021, we had more than 100 unicorns in Israel, which is about 8% of the total unicorn population in the world. And unicorns really do not exist, as you know. A kangaroo is a company that crossed $100 billion in market cap. And we have one company that was created by an Israeli, which is Palo Alto Networks, that crossed $100 billion. But while we were building unicorns, Silicon Valley has been building giraffes. Giraffes are companies that crossed $1 trillion market cap. 1 trillion means 1,000 times bigger than a unicorn. And I looked at those companies and I started to count them. There were about 6 of them. All of them are tech companies from the internet space, from social media, from AI, from cloud, e-commerce. And I noticed that there are no giraffes in China, in Asia Pacific. There are no giraffes in Europe. There are no giraffes in Israel, for sure. And a giraffe, if you build a giraffe in a little country, in a smaller country, its impact on the economy is tremendous. And I noticed also that the pace of building giraffes is starting to move faster and faster. Soon we're going to see the first healthcare company, and I'm leaving it to you to guess who that company is going to be. I'll just say that it's a company that deals with obesity. We saw Warren Buffett company touching $1 trillion as a value investing, which gathers a lot of great companies. But we're going to see very soon more and more giraffes. Now, I'm putting it in a slide just to demonstrate the mindset of the entrepreneurs I'm talking to. One may say it's ridiculous to think you can build a giraffe in Israel. And I don't want to create any illusions that it's going to happen tomorrow. That's not the case. But building a kangaroo is also very significant. And I see the trend. There is a herd of Israeli companies that are crossing from unicorns towards kangaroos. And some of them already won the ticket or earned the ticket to become members in the Fortune 500 companies in the world. And when I look at that, I'm very optimistic about the Israeli economy, about the future in Israel, about our entrepreneurs, about technology and innovation. There's something that is distracting a little bit the situation, which is AI, because AI is disrupting companies in a different way that we haven't seen before. Nevertheless, when you look at the human factor, it's always standing out. There are three things we need in order to cross to the giraffe savanna. We need access to markets, we need access to customers, and we need management teams that can scale those companies. And that leads me to next October. After October 7th, when Izar's son, Noni, was a hero and an ultra-charismatic young leader that saved the lives of many people fighting in Kerem Shalom, was killed. That triggered, besides, of course, the sorrow and the mourning, that triggered Izar's family to take action and to come up with next October. So I'm a believer that next October is an engine that will drive us from unicorns to kangaroos towards the giraffes world. And what I wanted to do is ask you to talk a little bit about next October.
Thank you, Chemi. So before I tell you about next October, I have to tell you that when we came up with the concept, we immediately looked for the people who would guide us, who would help us create the vision and volunteer together with us to create next October. And I must say that Chemi Perez was the first one to show his hand and say, I'm fully in. So thank you, Chemi. You're a great supporter and a great visionary, and we look up to you when we try to build up the next October vision and plans. So as Chemi said, while we were having our Shiva, the mourning period about Yaron, who was killed in a heroic battle in Kerem Shalom. For those of you who do not speak Hebrew, Kerem Shalom ironically translates into vineyards of peace. This is the name of the kibbutz where he and two other of his friends, soldiers, protected the entrance to the kibbutz and prevented terrorists from coming in and performing their plan as they did in other kibbutzim in the area. So the kibbutz was saved, and the civilians were evacuated a day later, but they were kept intact. So we were having our mourning period, and we tried to figure out how do we want to commemorate Yaron's special character. Thank you for mentioning that. He was really a charismatic leader. He had a passion for music and sports and had a very good sense of humor and so on. And then we came up with the idea of seeding a company. You know, there is a nice Jewish tradition where you plant trees on behalf of people who passed away or killed in terrorist attacks or whatnot. So we are 3 people in high tech in our family, Yaron's 2 brothers and myself. We said instead of planting a tree, we're going to plant a company. And then immediately we said not only a company on behalf of Yaron, but many companies on behalf of all those heroes who we lost on that day of October 7th. And then we developed this concept a little bit further and said, anybody and everybody whom we've lost during that day and following weeks and months, they deserve to be remembered. You know, the 3-month-old baby from Be'eri, the 85-years-old lady from Kfar Aza, who I know personally, and many others. All those civilians deserve to be remembered. This is a part of our second independence war, and we are going to make sure that we have enough high-tech companies to assign to each of the families of the fallen and the victims. Sadly, we started with a lower number than the one we are facing today. When we started next October in early November of 2003, the number was 1,250 people, more or less, that we had to account for. Today, very sadly, we're getting beyond the 1,750 people. But the mission is still there. We said we're going to have innovative, young Israeli startup companies endorse, adopt, and work with families of the victims. Each company will be assigned to one family, and together they are going to work towards the future in commemorating that person with that special person, personality, memories, dreams, passions, everything this person stood for. And that's the core foundation of Next October. We call this Next October, by the way, because it carries a sense of optimism, as it is the theme of our conversation. Next October will be better. We already have passed through one Next October, which was slightly better than October 23. It was a terrible month. We lost close to 80 people, soldiers and civilians, but still statistically much better than October of 23. And believe me, next October will be better, and the one after it, and so on. So that's how the name came about. It is also about the economy, the Israeli economy, as Chaimi mentioned. Building those companies creates the potential for the recovery of our economy. So next October is not only about commemoration, it is also about building up the next generation of the Israeli high tech. Think about 1,700+ companies, each of which carries Israeli innovation in whatever field the entrepreneurs decide to work in. Could be precise agriculture, could be fintech, cyber, AI, any other project that people decide to engage with. Think about 1,700 companies and the potential they have in order to help our economy recover. This is what the high-tech economy did in the early 90s, post the first Gulf War. This is what the high-tech did in the second Intifada, second Lebanese War, 2008, the COVID-19 crisis, and so on. So the Israeli high-tech has to take responsibility for the recovery of our economy, which, as Chaimi mentioned, many people already are doing. So commemoration and economy. And then the third foundation of Next October is important because it is a message to the world. And those of you who come here from the outside would appreciate if you carry this message forward. They came to destroy, and they came to eliminate everything we stand for. We are here. We are building new companies. We are building innovation. We are helping create a better world based on Israeli innovation. They came to destroy. We are here building the next generation of a better world. And this is the Next October. I go back to you, Chaimi. You and I have been here for quite some time. Do you carry now different marching orders? And you saw the crisis of the bubble in the late 90s, and then the post 9/11 crisis, and then the 2008 crisis, and then the COVID-19 crisis. Are you seeing any parallels in your practice as the leading investor in Israel, the leading VC in Israel? Did you change any of your policies to match what is happening now post the October 7th war?
Well, I think we live at a time where our industry is impacted by what is happening in the world in global phenomena. And global phenomena or global threats are basically attacking the whole world as one. I think that when you look at Corona, for example, it attacked everyone, everywhere. And as people said, it will never be over anywhere before it's going to be over everywhere. What I learned is that the world is shifting gears. Had a lot of discussions about that with my late father, who said that we are paying taxes twice as human beings. The first, we are paying taxes for not living the old world of wars, where nations fight each other, they kill each other, they conquer land, they enslave people for economic purposes. And those days should be gone because we're entering a new era with science and technology. You can actually compensate for any scarcity. You're not dependent anymore on the wealth of the land. If you need more energy, you can harvest energy. If you need food, you can grow food with technology. If you need more water, you can desalinate water. There's no reason for human beings to fight each other. Nevertheless, we as human beings are not living the old world fast enough. That's the first time we pay taxes. The second time is that we're not entering fully into the new era where we can really make the world much more sustainable, much more safe. Or in his own words, why use a sword to kill people if you can use a computer not only to kill but also to cure? And so the world is moving into a new era where together we're going to address global threats. Corona was one of them. You mentioned it as a crisis. And we saw that in order to address global threats, you need two things. You need solidarity, which means peace or better relations with other members that are not part of your people or country. But the second thing is you need to dive into technology, science, entrepreneurship to find a cure, to find vaccination, to find methodologies to deal with it. And that is my lesson. My lesson is that in the high-tech sector, we cannot leave it only to technology and innovation, but we need to pay attention to how we use it in solidarity and for a better use. That is the biggest threat in my mind, the ability to marry between technology and purpose. And this is something that in Israel, I believe the high-tech ecosystem is doing quite significantly. But I learned that we live in cycles, and after a crisis, there's gonna be a period of growth. You can look at it in the numbers. If you had here the governor of the Israeli bank, he would have shown you how through the years Israel has been prevailing and rising and continuing to growth. And I believe that we are starting that period right now. We are post-judiciary reform. We are post a situation where our unity was broken. We are at a point where we were attacked by our enemies that identified our being not united and attacked us. And we are not at the point where we are rising up. We're fighting back. We are moving forward. We have amazing people, and we're going to drive forward. So anyone who underestimates or undermines what Israel can do and will do, I want to share with you that the opportunities here are going to be amazing. And this is the time to invest. This is the time to look forward, not backwards. This is the time to take risks, because I believe that we are facing an amazing era of growth. While it's very hard to see because of the pain and all the things that we are encountering on a daily basis, soldiers are being killed, people are out of their homes, people are going through rehabilitation, we have hostages, terrible situation. But I'm a believer in the Israeli people, and I'm a believer in the Israeli technology ecosystem. And I think that when you look at what Izar and his family are doing with Next October, they are fulfilling and empowering that full ecosystem in an amazing project that gives extra motivation to break through, to rise, and to grow. So, yes, we've been through crisis, but you have to be resilient. And you know that beyond that, there's going to be an amazing time of growth.
Right. If I had any dent in my optimism on my way here this morning, thank you for raising the level up of optimism. Natalie, do we still have a couple of...
1 minute. I'm overlooking you guys. You can raise the flags, but I don't know how to read numbers.
So I'm running the risk of doing something out of, but anyway, you know, on Yaron's, one of Yaron's saying that we keep repeating is better ask for forgiveness than for permission. So I'm not going to ask for your permission, but I'm going to go some difficult route here. So Chemi, on the very deep personal level, you and I went through significant tragedies. You lost your son, I lost my son, and we are speaking about optimism here amidst everything that is going on around us. Do you think that your personal tragedy helps you cope with the situation now, gives you a different perspective, gives you a different view than the, so to speak, regular lucky people who didn't lose any of their dear ones?
Yeah, well, it's a pain that I don't wish anyone to experience it. It's a very tough burden to carry through your life. It's not going to be easy, not in the future. There's no cure. But I learned one thing, and I was prepared in a way by assuming the position of chairman of the Peres Center. And when my father passed away, I thought about his legacy and how can I make his legacy alive. And I learned that through the years, legacies that are based on memory tend to fade away. They tend to be forgotten because people don't remember things as time goes by. There are new issues and so on and so forth. So for me, memorying and commemoration is not about the past, it's about the future. So the Peres Center embraced that idea that my father's legacy is about tomorrow, not about yesterday. He said, you cannot change the past, but you have to shape the future, and you have to make a choice. So when my son passed away, unexpectedly, out of a heart failure at the age of 33, it was a shock for the family, but we decided to carry his vision and his ideas, and we continued to create what we started to do when he was still alive, by building a future for people who love the world of comics, the world of creativity, the world of music, the world of games, and so on and so forth. And we've done it in two ways. One is in a sort of a company that we started together, and the second one is through a non-for-profit activity in Shankar. And Guy is alive with me every day. And when I see the impact of what we are doing, how we are helping other people to realize the dreams that he had, that carries his memory forward and make it unforgettable. When I saw what happened to Izar, it broke my heart. My heart is being broke every time there is a family losing a son. It's not helping you carry the load. It just continues. It triggers again and again. And people who did not lose children cannot understand the pain. It crushes your family. It crushes your life. And this is why I'm so longing to see this war over, I have friends that have kids in Gaza, and I look at the government, I look at them, no neshama, no compassion, nothing. They treat the families as if they're an obstacle to achieve something. And it's unimaginable. And what I saw, when Izar started with his family next October, I said to myself, these guys are going to carry the memory of Noni, and we are all going to feel it in our daily lives. So I think, to answer your question, I think it made me a better person, because the way to cope with such a loss is to do something good on a scale that has no limits. And you push that doing good as much as you can in order to carry the burden of memory and suffering.
Yeah, and I will echo your concept of making a decision. For us, it was about making a decision to live our lives as we should have if Yaron had been with us, which means living a happy life and doing something meaningful. For us, this means to give back, to build up, to be optimistic, and to make sure that everybody around us understands the price, not because this is about us. This is about us as a society. We have to live up to the sacrifice that all these young people made in order for us to be able to live our lives here. So yes, we have to go back, we have to build, we have to run our daily activities, and we have to remember that these young people set the standard for all of us, and we have to live up our lives, not only by commemorating them, but also by deserving and appreciating the price and the sacrifice. I think this is a mission for all of us.
Absolutely.
Thank you very much.
Hi everyone, my name is Devora, and I'm the regional manager for ICE Data Services here in the Middle East, in Israel, and in Africa. At our core, ICE is a company of exchanges and clearinghouses. We got our start in '99 as the Continental Power Exchange in the United States, and today we've grown to 10 exchanges and 6 clearinghouses. Most famously, we are the proud owners of the New York Stock Exchange, which I'm sure most of you have heard about. Today we are a $136 billion market cap company, and we are a key player in the global economy with almost 13,000 employees across the globe. 300 of them actually sit here in Tel Aviv. ICE Data Services completes the picture by providing a full suite of data and analytics to banks, asset managers, investment houses, hedge funds, and corporations worldwide. Today, we are a leader in fixed income evaluations, and we cover more than 3 million instruments, govies, corporates, sovereigns, as well as MBS, ABS, CLOs, and more. We do live intraday prices, end of day, liquidity metrics, corporate actions, tax, sanctions, it runs the gamut. $1.8 trillion is benchmarked to ICE indices, and we work with the likes of BlackRock and other industry leaders on fixed income, equity, and commodity indices. And I guess most importantly to my mind, ICE acquired an Israeli startup called Super Derivatives, you might have heard of them, about 10 years ago. And they became the basis for us here in Israel for cross-asset derivatives pricing, analytics, and risk management. Today, as I said, our Tel Aviv office employs about 300 people. We have about 3 floors in the round building in Migdal Agol, Israeli. And we are the global R&D center for ICE worldwide. Many of the people here in Tel Aviv are Olim like myself, Ishai, David, Johnny, a bunch of other people that are here representing ICE. Our colleagues are soldiers that go on Miluim. And sometimes we even have client meetings in the Mamad, which happened to me just last week. But with all of that, we are proud to be a part of the vibrant ecosystem that is the Israel economy. We are also really proud to be a sponsor of the Israel Hedge Fund Association and a part of the incredible work that Natalie and her team do. Finally, I want to close for a prayer for our soldiers and hostages. May God keep them safe and return everybody home. Now it is my pleasure to turn it over to Harel Gilon, who is the managing partner of Oppenheimer Israel, and he'll be moderating the next panel. Thank you.
So, good afternoon, everybody. I hope that all the people that are outside will get inside, because we're going to reveal the number of the S&P 500 by the end of the year, or at least for today. But the first, the Izar and Hemi's short panel was inspiring. Thank you very much. We'll try to do a break from that and deal with the local world or global world things and issues, while we still have to take care of the investments of the Israeli pension funds and savers. And next to me are people who manage hundreds of billions of dollars for the Israeli pension funds. Can you just quick presentation of yourselves? Avi, let's start with you.
Hello, good afternoon. My name is Avi Kimhi. I represent Gilad Pension Fund, which is an old type of a defined benefit pension fund in Israel, a sectorial fund. I've been around for the last 23 years in the local market, the local financial market, representing major financial companies in Israel.
Hello, my name is Maya Avni. I'm the head of the foreign fixed income from Migdal Insurance. I've been around in that area for global markets over 20 years, and happy to do that.
Hi, hello everybody. My name is Eran Elad. I've been at RL Insurance Company, one of the largest pension insurance company in Israel, over 13 years. I'm head of global markets and in the industry over 25 years now.
Hi everyone, I'm Galit. I'm the head of global credit. We are a bit different than Minora, so we cover both the private side and the public side. I'm about 5 years in Minora and about 18 years in the industry.
So I think we've got almost 100 years of experience here. Let's see how much you know. So let's start with our first question. In light of Trump's victory, what immediate adjustments do you believe institutional investors should make? And do you think that the fears from global inflation are accurate, are justified? Please, let's start with Avi on this one, first one.
So, I think that what we're experiencing today in the global market since Trump and the red wave that came across the political landscape in the US is an animal spirit effect. The bar is very high for this government now to introduce and continue the growth momentum that sprung in the US after the COVID. He's got a lot of social issues internally that needs to be addressed. And because the bar is very high, and we went through a couple of months of instability in markets and volatile markets, preparing for what the outcome is going to come, the first effect is quite positive. But there's attached an inflation premium attached to this specific government. I think one should scroll back a little bit to the last government in 2016, and to try to see how markets reacted then. I'm not saying it should be a copy-paste. Of course, things are different now, and hopefully some of the mistakes that were done in the first term of this government will be addressed. I think that the outcome could be and has the potential to be volatile, but positive. Regarding the inflation, I think markets are volatile. They have the tendency to outpace themselves. So one should take a long breath, and try to gather more data before deciding that risk premium in the inflation should go higher for the next 4 years.
So Avi thinks that we should wait and watch a little bit until things stabilize and see the real direction. What about you, Maya? How does you?
I think there is a lot of points that Trump has pointed and the market has been expected. I think the main question is how will we achieve? I agree with Avik that we need to see and look. I think there are some points that he will be able to do more. And I think in terms of the tax reform, so in one hand, I think the possibility that he will maintain what we see today, the tax regarding companies, but the question if he will reduce it dramatically to where he was expecting, and the market is somewhere expecting that, that is a big question of how other things will come around. So I think in one hand, he has promised to the market that he will finish the wars in the world. And I think that is some sort of a card that he will play going to the tariffs as well. So I think there's a lot of questions, things that he can do directly that impacts in inflation, but there are other things that comes around. So therefore, we need to wait and see how things follow up. I do think that at some point, maybe the expectation for inflation going to the Fed's target is not going to be there because of things that he might do, first. It maybe not going to be dramatic as been expected, but he will do some. So maybe we'll see inflation not going to the target that the Fed has been expected, but not that high. So in some point, maybe 2025 will be a bit more, but not that dramatic. So it really depends how things will follow and what he will be doing. And I think there is a lot of cards on the table, and the question what he will want to do more. So we need to wait, but still it looks like it's a positive for markets, especially I think for equity. And volatility is definitely going to be, but it looks positive, less than negative.
So I'm gonna challenge you a little bit, Galit. From one hand, we've got the markets that are exceeding expectation, going high and higher, and it's like a huge celebration out there. And on the other hand, we see the inflation concerns that Maya is saying that it's going to be moderate, but not all the capital markets people think it's going to be moderate. And those are two vectors that are opposing each other. What do you think about this?
So we do think that inflation will rise a bit, but not too much. That's why in the global fixed income portfolio, we even reduced a bit the duration of our portfolio. But I do have to say that we also reduced our allocation to the government bonds and to the credit, like in general, because we think it's not the best asset class right now. We prefer to be in the equity side. We prefer to be in US. And we think about the sectors that can benefit from this, like US banks, like the healthcare. So because we don't really know what will happen to the inflation, we're trying to be in the other side right now.
Okay, thank you very much. So the next question goes to you, Eran. If the allocation to global markets has increased, how has this affected the currency hedging strategy, especially given that institutions are key drivers of the exchange rate locally, of course?
Sure. When we look at the way we allocate between local market and global market and the hedging currency, we look at it in a very long strategic approach. On the one hand, we have a strong confidence and opportunity invested in Israel, for example, like the financial institution, the residential housing sector, and especially the high tech, which is one of the main drivers for the economy. But the scope and the lens of our portfolio enforce us to diversify to global market. And then we can create to our clients, to our investors, exposure to leading companies, leading sectors. As Jaime said earlier, some kangaroos, some even giraffes, and some even global unicorns and also the local unicorns. But our main focus is to generate returns in shekel terms to our clients. So while we diversify to global market, we also increase our exposure to a single major risk is the FX exchange. And we are aiming to reduce this risk. We are totally aware of the hedging costs by doing that. But then we look, and when we do it as effective as we can, we try to hedge most of our global exposure back to shekel. And then we can create a diversified global portfolio and minimize the FX volatility that most of our client is not looking for it. They are looking for the global diversified portfolio, but in shekel returns.
Okay, Galit, we have prepared for this. What do you think about this?
So I have to say that the institutional clients in general, they are the main driver right now for the currency. We invest a lot in the global markets. I have to say that Minora invests about 50%, even more than 50% in the global markets, because the local market is too small for us. We cannot invest even if we want. We hedge about 50% of this global exposure, so it's a huge amount of money. We do increase our exposure to the currency to dollars because we don't think the shekel will strengthen again in the short term. We do think that in the long term, shekel will strengthen again. It will come back to the normal rates that we are familiar. So in the long term, we will increase more the hedges, but right for now, we don't increase the hedges, and it's also one of the reasons why the exchange rate is going up, because we buy just at the currency and we don't hedge it.
Well, I tend to agree with what you said. I think that if peace suddenly breaks through, we will see the shekel strengthening again. We will see more and more investments coming in, and we will see more and more hedges, which will push down the exchange rate. And we'll have to wait and see. Until that, you need to play the game where if the shekel weakens due to the geopolitical situation and the war, you need to be there in order not to lose those percentage versus your competition.
Actually, I have a remark. I'm the smallest of this band. So because we're a sectorial pension fund and a closed end, our AUM is quite small relative to my bigger competitors here. So we do not have the problem in navigating in the local markets and the foreign markets. So my personal beliefs and methodology is staying active. So we try and do our best efforts to navigate between the local and the foreign markets. And when talking about FX, one should remember that since 2023, when the judicial reform started to gain traction, a lot of the correlations in markets started to break. And some of those reasons are being discussed here because the local big pension funds and the financial system are too big for this market. And they allocate more and more investments to the global markets. In private and public markets, they have a huge effect on FX. And once the social instability started to gain traction here before the war, correlation between foreign markets performance and FX here started to break. And in reality, that got the big institutional players to enhance their FX exposure. And since the war broke, I see this instability and correlation evolving again. And I do agree with you that God's willing, once this war will be over and all the kidnaps and our soldiers will come back home and we'll start rebuilding, we'll see a massive volatility in the local market, in FX, equities, bonds, everywhere. So hoping for that minute.
So until that happens, I want to come back to the local, global allocation, and in what way has this situation in Israel influence the allocation between Israeli and global markets? Maya.
So in one hand, we saw that the valuation for Israeli assets are really attractive. We saw the bond of the 10-year of Israel going above 5%. That is most attractive. But still, we're in a geopolitical issue in Israel, so we did shift some of our allocation to global markets versus the Israeli investments. I think we went around from 20% to 25% from the shiftment on the currency as well. That's what we did. So we did do that, but things has been changing since then.
So can you say out of every new shekel that comes in, how much is allocated outside of Israel? Not mentioning the product, whether it's real estate or private equity or just cash products. The numbers that I'm hearing is that more than 70%, 80-70%.
No,
So,
that's
yeah.
true, but not everything has been hedged back to shekel. So the increasement of the hedging cost was from 20 to 25, but yes, indeed, a lot of it is going up to the global markets in different assets. So that is also has been changed.
Just for a question, I don't know how many you reviewed this morning in Calculist from Bank of Israel with respect to the exposure of a local institution to the S&P products. And this is a quite shift in the taste of the flavor of our local investors. We're shifting to passive ETF exposure, not hedge to back to shekel. And we see the huge shift in the last 2.5 years, especially from the end of 2022. And this is roughly, you can calculate it about, from those 80%, more than a half is go to this product, to invest in global markets, passive global markets, and non-currency hedge. I don't think Andrew is here anymore, but if you would ask him, he would ask us not to hedge our FX exposure and to stay in dollar terms.
Well, he sits on a $250 billion position or something like that. So he can definitely also have a huge effect on the currency whenever they wish or whenever they think that things fluctuate too much. So I wouldn't worry, in that case, from the dollar rising too much. But when it goes down, they will always be there to support. I hope there's still some on the higher end.
Sure. Actually, to be totally honest, and what the Bank of Israel did was in October 9th, it was amazingly, both on the FX and on the bond, it actually gave as a last resort what central bank should act, and trying to say to the local market and to global markets, we are here for business and we continue to do business and can continue to invest it. And true, it took a few months, and then it stabilized the market, both the FX and the fixed income. And we've seen the trends are changing, the recent ones.
So let's move into the next question. That how do you anticipate the current geopolitical instability impacting your target allocation in the future? Meaning that we know what you are doing now, but what is the expected future one? And it's also global. We have instability all over the world. It's not just Israel and its neighbors. We see Trump going into some sort of a trade war with China. We've seen the Europeans with China also, tariffs and electric car taxation. We have still the war in Ukraine. We see the world becoming more local. How do you think you should allocate or make changes in your allocation? Galit, maybe.
So first of all, we need to remember that we are very long-term investors and we don't really change the portfolio very fast or a lot. We do see the things that right now, the Trump, China, Ukraine war, that's why we focus mainly on the US right now. We also focused on the sectors that can benefit from this, like the high-tech companies, like banks, like healthcare. And we have like barbell strategy. We invest mostly right now in the US, in the equities, and the government bonds in to mitigate the risk. We don't really like the corporate risk right now. We think it's too expensive. So it's very balanced portfolio, and it's supposed to be for long run, and it's something that we need to remember every time. It's for long run, and we can't suffer the volatility that they will be in the short term.
Avi, I see that you are prepared to, preparing yourself to speak.
Yeah, there's different types of geopolitical events. Those are those that are policy enhanced, such as those we're talking now about Trump and China and everything's going on. And there's regretfully very tragic geopolitical events, such as those we are experiencing here in Israel as of today and in our past. So trying to hedge, because that's what we're thinking here, against each type of geopolitical events is different. When an event is a surprise, as a tragic one we're experiencing, it's hard to hedge against it. When it's something that is policy enhanced and induced, so we have different ways to try to navigate our portfolios in order to try to mitigate the risks. And regarding today's geopolitical instability, etc., I think that the last 15 years we are seeing more and more events, and the magnitude and the amount of time it happens are more than what we saw in the past. So yes, building a balanced portfolio that can endure those type of volatility events is very important. And on top of that, I think that one should be very, very humble when approaching market, especially when it's a very long-term instruments of investing such as pension fund, insurance company, etc., and not to overplay a specific event in changing the allocations. And for my colleagues here, it's also difficult because it's moving massive amounts of funds from one asset class to another.
Maya, what can you say about this?
I think the way to look at it, and the way we look at it, is in terms of the geopolitical, is one thing that Avi mentioned is when you look on Israel, for the way we see it, is once we have Trump that has been elected, has been talking about finishing war, and in the other hand, we see that there has come to some sorts of talks with the North in Lebanon. So this kind of thing did make us more feel that we do not want to continue reducing our allocation to Israel versus global. So that is in one hand. The second thing is what we see when the fact that Trump has actually won the elections. And of course, there is the tariffs and there is the US economy. So in that point, we have seen that we are more favorable for the US market versus the European market and the EM market. So that's sorts of shifts that we have been doing and going forward. Of course, everything can be changed, and, but that is the aiming.
Okay, thank you, Maya. That's very insightful. We actually are right on our original time, although we started, so you spoke very fast. But I'll drop in a bonus question, which we did not prepare for, but you can be free to ask or not. I came across a product that maybe some of you know, that is an ETF 500, an S&P 500 ETF that does not include the Magnificent 7 stocks. What do you think about this? Is this something, and of course we see in all the media press, economical media press, that after Trump election, they're not going to be that attractive as they were before.
Except for one.
Which one?
Tesla.
Tesla, of course, yes. Okay. So, what do you think about this? Is that a right approach, going for small cap or other sectors and not those magnificent 6, except for Tesla? Is the era ending?
Well, when you look at the S&P history, okay, for more than 80 or 100 years, you look at previously, like every other decade or so, the top 10 companies are changing and evolving, and I guess no one else knows to predict which are the best company will be. It's true that now these companies, especially with the hedging they have, the gap they open against with the AIs and the internet, have a huge gap on their peers. So to accept that in the next few years, those going to change very dramatically, I think it's a little bit too big risk to invest for institutional investor. It can be as a diversification. You have also like equal weight ETFs or X-Tech ETFs. But again, and you see that those companies, it can be sometimes the railways, sometimes the banks, sometimes the energy sectors, in change from time to time. But to bet exactly when the day is going to be, it's a little bit difficult for us.
Anybody else wants to answer that? We are all done.
No, I think that in the end of the day, the big 7 is they are in the sector that's actually aiming going to the future. Those companies are there. It's not like an old technology or something that is already been done. This is the future. So I agree with Eran. This is much more difficult to try to navigate, and especially the enormous and the amount of how much big they are. So I agree with that, with this conception. Yeah.
Well, I would like to thank my panel. Looks like it's very difficult to be an asset manager in these times or ever, but you're probably doing a good job, and continue with that. Our pensions are in your hands, and hopefully we'll, how do you say it, go into the future together and make money. Good luck.
Thank you. Thank you.
Thank you.
Thank you very much.
So hello, my name is Danny Cookerman. Happy to be here from iFunds. We are iCapital's partner here in Israel. And for those of you who don't know iCapital is to date the largest global platform that provides access to alternative investment funds for the wealth management channel. Organizations such as UBS, Morgan Stanley, Raymond James, Bank of Singapore from the advisor side, and the GPs like Blackstone, Silver Lake, Carlyle, Apollo, Millennium from the GP side, all trust iCapital and work with their tech, their distribution, and with their processes when wanting to approach the wealth management channel. About 3 years ago, when we began working with iCapital in Israel, we boasted an AUM on platform of $60 billion. Fast forward 3 years, it's tripled to over 200 billion, just to give a sense of what's happening in the alternative investment space when it comes to wealth management. Here I don't feel that I have to preach to the converted about the place of alternative investments in a portfolio. But when we think of this industry of hedge funds, obviously, private equity, private credit, private real estate, it does come with its complications. So if you think of choosing the right manager, investing in the right structure, choosing the right access provider, reporting, onboarding, low enough minimums, and the list goes on and on. iFunds, together with iCapital, solve all these complications. We provide both advisors and their clients simple access, top managers, full due diligence, and full transparency to both products, terms, and attributes. I want to invite the allocators panel and assure you that any allocation that they're going to be talking about, we probably have it on our platform. Thank you very much.
So hi everybody for the second time. Very happy to be here with our panel of allocators. And it looks like that not because there aren't too many allocators in the Israeli market, just because they're miluim and we're somewhat in the middle of war, but we're alive and kicking. So thanks for being here. Guys, do you want to, I suggest you introduce yourself. Ariel would like to start.
Sure. Hi, so I'm Ariel Bino. I'm the CEO of Gilboa Funds. We run hedge fund of funds since 2014 and private equity feeder funds.
Hey, I'm Ophir, CEO of Kaspa Family Office, existing for more than 18 years, right? That's it.
Excellent. So, as I've mentioned, for those of you who were at the opening ceremony, and when I talked a little bit there, we're definitely in a very unique year, very different environment. And whereas hedge funds normally thrive in volatile market and in crazy markets, it's still very difficult. You heard it from the institutional panel earlier. Wanted to hear you guys and your thoughts, and but we'll start with you first, just because. But about allocating into hedge funds in this market, with emphasis on what's going on, kind of here in Israel and globally, right? Even before the war, the global macro events, everything that happened with the war in Ukraine, the trade war between China and the U.S., Chinese Sea, and everything that's going on there, and obviously the Middle East, where there is never a dull moment there, was there. Obviously for us locally, things have changed rather dramatically since October 7. So it creates both a global challenge and a domestic challenge. Would love to hear your thoughts about the way you see it in terms of allocating into hedge funds domestically, globally, and obviously not to mention that a couple of days ago, when we first talked about, we didn't know how the elections in the US would go, but then we have Trump at the White House going to shovel things there as well. So with all that in mind, we'll have to get your thought. I will tell you that we would love to have it as kind of an open discussion. So since there's some emerging managers in the audience, etc., so hopefully at the end we will have some time for questions. So go ahead.
Yeah, so let me maybe a little bit introduce you to how we look at things. From our side, there's a major difference between allocating into local Israeli hedge funds and global hedge funds. So as you all know, the Israeli market is relatively not deep enough. It's volatile, correlations are high. As opposed to that, the global market is very deep. It's got momentum-driven moves, and it's highly and correlation also move on a momentum basis. So all the things that we have endured for the past year, for the past years actually, only exacerbates the differences between the Israeli market and the global markets. Of course, Trump's future presidency will also add some dimension for that. We all remember 2016, which the previous Trump presidency, which we all thought about replacing our Bloomberg terminals with Twitter push-ups. We didn't know what will be next day. So markets are very, very different as a whole. On the local side, we actually prefer emerging, agile, dynamic managers that can take advantage of the Israeli market. We will usually prefer them over, most of the time, over the high AUM, heavy to move funds. On the global side, it's relatively different. We'll most of the time go for the AAA names, and we would like to pinpoint a specific strategy that we would like to implement and add to our overall portfolio allocation. So to sum up, at the end, what we're trying to do is to get to a specific yield target, which is hopefully a double-digit area, coming from as low as a low correlation strategy as possible. So that's the main idea.
Thank you. Ariel.
I think when we look global versus Israeli, what do you want from a hedge fund, right? Low correlation is one thing. Second thing is alpha. How do you generate alpha? You need inefficiencies. It's financial markets are a zero-sum game. There's a positive return over time, but around that positive return, if you want to generate above-market returns, it has to come at the expense of someone else. And for that, you need inefficient markets. I agree with you that the Israeli markets are less deep, but also less efficient. And what we've seen with Israeli hedge funds, predominantly ones that operate in the Israeli markets, that they're consistently able to generate above market returns. For example, if you look at the American markets, I do believe that the S&P 500, I think relating a little bit to the previous panel, tends to be efficient over time, so buying index fund is generally good advice for most people. I think in Israel, what we've seen is Israeli hedge funds consistently beating the local indices. So I think in the local markets, Israeli hedge funds have a very big advantage. I think in the last 2 years, with everything that's been going on in Israel, we are seeing money shift abroad, but interestingly enough, not at the expense of hedge funds. I think it's coming out of other products in Israel and money going overseas. And I can't argue with investors who are worried about the local market. I mean, we could see positive outcomes, but there are things for concern. So we are seeing money going overseas, including to hedge strategies.
Thank you for that. And you both touched upon that, but I would love to, a little bit upon that, but I would love to hear your view about your thoughts as to the role of hedge funds in a diversified portfolio, right? I mean, there are different investors, different allocators, where is it high net worth endowments or institutional investors look differently on this issue because their portfolios are constructed differently. But Ariel, you talked a little bit about generating alpha and perhaps versus risk management, diversification, etc. So would love to get your views on that, both of you. Yeah.
Yes, I think what we see is that in foreign markets, hedge funds tend to act more as a diversifier. And I think where we are in the market today with equity prices high, multiples are high, interest rates remaining being high, but spreads very low. So I think especially under these kind of conditions, hedge funds could provide a very good diversification for portfolios.
Yeah, if we try to describe exactly the bucket of where exactly hedge funds sit in a global multi-asset portfolio, it's right in the middle between liquid and non-liquid asset. Its main purpose is to produce alpha, but over time to flatten the overall volatility of your entire portfolio. So there's no doubt that, you know, in a low beta market, up market, most of the time, long only investment will do best. We all know that. It happened in the past. Post the GFC in 2008, I think we saw volatility VIX between 10 to 20. S&P intercorrelation, which means how correlated are the stocks themselves within the index itself. Are they going up or going down together? It was around 35%. So it was actually a great decade for passive, long-only investment, one-way ticket. In the last year or so, we saw a little bit higher VIX because it was a high wall of worry. Okay, if you remember, only a couple of months ago, the world was divided in two. Half was saying you're in for a definite recession. You just name your date. The other half said inflation will be back. So we had a very high wall of worry, but it was accompanied with a relatively very low S&P intercorrelation of 15, which was manifested, of course, as you all know, in outperformance of the Magnificent Seven, because everyone wanted to play it safe. And also another result was the historical outperformance of large cap over small cap, which, by the way, the last couple of weeks, because of Trump, it's
changing,
closed a little bit.
And some were saying going to change for the best for the small caps and some sort of a revival.
Yeah, exactly. At the end, we all have seen unprecedented events for the last 4, 5, 6 years. I don't remember any of the related experts predicting it right. So at the end, it all comes down to where do you put your emphasis on, okay? And we prefer managers or strategies that put their emphasis on research capability instead of predicting capabilities, because most of the time prediction capabilities are proven wrong.
So that delves exactly into my next question to both of you, because we talked from a kind of top-down, a global macro events globally that changing the world, but also impacting portfolios. We talked about a little bit about your views on where hedge funds are in a diversified portfolio. Would love to dive a little bit deeper, kind of a bottom up, and to understand what are the qualities, so kind of a two-phase question. What are the qualities that you're looking for in a manager when selecting and due diligencing a manager? And secondly, whether you're looking at it just merely as alpha generator, P&L, or whatever diversifier, or are you looking for some more, I would call it added values for that managers? On our talk, in our discussion, in preparation, we talked about, okay, so we have a hedge fund manager with a unique strategy. Does it give us something beyond the P&L and the alpha for our portfolio? So, yeah, Ariel would love to.
Yeah, so for us, the main question we ask with any manager that we want to add to the portfolio is competitive advantage, the way you analyze a business.
Yeah.
So we need to find managers where we see a very clear competitive advantage in what they do, which is not always hard because you have a lot of actors.
Yeah.
In the Israeli markets, we look mainly for alpha generation. We look for managers. I care less about correlation. I want just managers that could provide as significant as possible alpha compared to the local markets. When we look abroad, and now our investors are looking for more global products, there, like you said, we're looking for other qualities as well. We're looking for things that can add diversification and low correlation. So we'll look typically in macro strategies, relative value, maybe some more exotic type products. Also, one thing I would add though is that when we look abroad, we will try to find bigger players with more experience and larger size. In Israel, because the markets are
longer track record.
Longer track records as well. I mean, in Israel, we're much closer to the managers. So I don't mind investing with managers that manage 100, 200 million shekels. I know where they're vacationing, where their kids go to school. It's easier to get familiar. When I go to global markets, I have less information. So I rely more on reputation. So the reputation needs to be stronger and longer term.
Yeah, I agree. So I would just add to that, the hedge fund industry has as a common denominator very similar to the private equity industry, which means it's all about the people. And most of the time, strategy comes only for a second. You have to be agile and know how to manipulate the market. The right team has to be also, of course, super professional, but also have a lot of passion for the market. It has to be passionate about that. If not, they will not be consistent over time. So as I said earlier, if we compare a local to global manager, so our local process will be much similar to what Ariel had described. We will not shy out of small emerging managers, which we know are has the potential to be really, really good, and on the other way around, we will shy out of them when they become too big and less agile. In global markets, we usually go for the AAA names because we know all the names, and we know how to pinpoint the exact strategy we would like to have access to. Overall, we work in global, in an open architecture kind of strategy, which means even for local managers, we compare every strategy we see with global competitors, and there's a lot of talent also here in this audience, but also outside. So it's done with the comparison on a comparison basis. What else?
I'm wondering why you think that. I mean, obviously, you know, we saw the numbers earlier, Ariel, and thank you so much for doing it for so many years and gathering this data. What are, in your view, what are the reasons that Israeli managers outperform global peers?
I think it's two things. One thing we started looking when we started Gilboa is it came from a question from one of our investors. He said, because we were saying, look, the markets here are less efficient and the hedge fund industry is relatively small compared to the market. So one of our investors asked, what's the difference? How small? So we took as kind of a rule of thumb, we looked at total hedge fund assets compared to total market cap. And I think it was like 6-7 years ago, it was 1%.
Okay.
Compared to the US, where it was 10%. So hedge funds, or kind of more agile, or managers that have more flexibility, or were at least a relatively small part of the market. Israeli markets are less efficient. It's dominated by fewer large players that take time, are slow to move very often. So if you have small, agile players that know, understand the investor base, they understand flows, plus they're very close to companies. You know, an hour and a half, 2-hour drive from the center, you can get to anywhere.
So you're thinking, so it's predominantly their local. You know, they're local players, so they have an advantage in the local industry.
Local players and less players and less efficient markets. Yeah.
Interesting.
Yeah, I basically agree, and I think that it was said here in different words on different panels. I think that as long as we stay in a relatively real positive interest rate regime, which has been very unusual to what we've seen in the last decade or so, active managers will have much bigger chances of beating passive ETFs. And I really hope this is the situation.
Especially during volatile markets, where being agile,
exactly.
And kind of.
One small thing I would add is there was also a problem with the passive indices in Israel up until recently. The way they're designed, the way securities are added or subtracted, especially in equity, gave local players a big advantage. I mean, they could almost forefront, run ahead of the indices. Yeah. You know, they would bet, okay, which are the companies that are going to enter the index in 6 months, and being able to buy those ahead of time.
On it, yes. And again, being agile and being dynamic. Excellent. So maybe last question before we run out of time is what the type of giving where we are today. So for the short run and kind of midterm, and what are the strategies, the kind of the hedge fund strategies that you guys are looking into thinking that those strategies would perform well in the next 6 to 12 months?
Yeah, okay, so I mentioned earlier the wall of worry. About $6 trillion of US dollars now sitting in money market funds. There's a lot of money sitting outside and not going into risk assets. So overall, exactly what was the question exactly? What do you want to know?
The type of strategies, whether it's long-term equity
Yeah.
or credit,
Yeah.
or maybe commodities.
Yeah. So valuations today, of course, they're stretched. Okay, for risk assets, and as wall of worries reduces and people become more optimistic about the market and get in, of course, that's the time for you to reallocate to hedging strategies and go out of the long-only strategies you hold. We are starting to do that as the market goes higher and higher. We're starting to allocate more into long-short market, global macro hedge, all those kinds of things. It's a process. Yeah, it's not done from one day to the other. On the debt side, after many years of low rates and low interest from everybody, actually, debt market has a really nice return at the moment. So actually, on the debt side, we still prefer, as long as rates are still high and not, we only started the reduction in rates process. We still hold more plain vanilla long investments. I assume a year from now, maybe we'll be 100 or 120 pips lower in rates. It will be time to implement the same kind of procedure done today in equities on debt, and go back to structured credit, merger arbitrage, all those kind of things that can on average get you a low double-digit return with low volatility, as compared to today, what gives you the same kind of asset on the liquid high yield and senior loans.
Thanks.
For us in Israel, we like equity strategies. We think there's a lot of room for upside if things get solved here relatively quickly, especially in equities.
So kind of long biased, or?
It could be long, short. I think chaos is good for hedge fund managers. And we see also room on the upside. So either long, short, long biased strategies.
Valuations and that went down. And
yes. So in Israel, mainly equity. When we look abroad, we like debt, distressed debt, macro, relative value, those type of strategies.
Great. Thank you so much. We'll probably have
time
for one question, but if no, thank you so much, guys.
Hi, Paul. Thank you for joining us. Hi.
Hi, Ma.
Hi. So, okay, you can start.
Okay, well, thank you, Natalie, and thank you very much to the Israeli Hedge Fund Association for giving me the opportunity to speak very briefly at your conference, and also thank you from the TMX. Can you hear me?
Yes, we do.
Okay. And thank you as well from the TMX Group to the Israeli Hedge Fund Association for partnering with us as sponsors of the conference. And thank you particularly to Natalie, who's been brilliant. Now, I need to say, first of all, I'm particularly sad that I'm unable to be with you in person, not only because I've always loved my trips to Israel in the past, but also, obviously, because of the current wartime situation that you find yourselves in. But before I hand over to Sario and Yuri, I just want to say a few words about the TMX Group, for those of you that perhaps don't know us that well or what we do. So, briefly, the TMX Group houses within it the Toronto Stock Exchange, which is Canada's largest equity exchange, listing some 3,500 stocks, as well as over 1,000 ETFs. And from a trading point of view, maybe from a hedge point of view, it's quite interesting because 280 of the stocks that we list are also interlisted in the US, which attracts a lot of interest from proprietary groups. That may be interesting to some of the hedge funds. It's also very important to mention that in Q1 of next year, which is quite exciting, we are launching a new US platform, a new US alternative trading system called US Alpha, which will be solely trading US stocks. And the execution methodology may be particularly interesting to those funds among you. So that's one to note, Q1 2025. Also, within the TMX group, we have the Montreal Exchange, which is Canada's only listed derivatives exchange, and houses a liquid suite of Canadian fixed income suite of Canadian 2s, 5s, and 10s, as well as a 3-month interest rate future. We also list a suite of individual equity options and ETF options, which have seen sustained growth over the last few years. Now, we have, just briefly, we have TMX Tradeport, which some of you may or may not have heard of, which is our very successful global power and gas emissions exchange. One group that I work with very closely is within the TMX group is our data business called TMX Data Links. And as the name would imply, we have the ability to supply you with global data sets covering a whole wide range of products, including real-time historical data, corporate actions, and a whole range of analytical platforms. Now, I must mention at this stage TMX Vetify, our global indexing business, because I would like to take this opportunity while talking to the industry in Tel Aviv to welcome to our Canadian family Index Research. Now, I believe that Yaron Diagi, who's the head of global markets at Index, is in the audience. So I'd like to say a very special hello to him and also to the rest of the team. And Yaron, I love working for the TMX group. It's a great place to work. Now, I've run out of time. My name, Paul Dex. Please connect with me on LinkedIn. My email is paul.dex@tmx.com. Please get in touch about anything that you'd like me to follow up on. Next time, I would really hope that I will see you guys in person. Now, with that, Saryu, I'm going to hand over to you to talk about volatility, which I think there has been quite a bit of since the summer.
Thank you, Paul. Hey, Sarju. Hey, hi, Yuri. I'm good. Hello, can you hear us? Yes, loud and clear. Great. Yes. So my name is Sarju Gupta. I work for the CBOE, the Chicago Board of Options Exchange. You probably know us for our flagship products, the S&P 500 cash-settled index options, the VIX futures and options, the 1-month implied victories with the S&P 500. We also have a range of equity exchanges around the globe. 50% of the market share across the European landscape. Recently set up a Japanese exchange and an Australian one as well. And we launched an innovative new pan-European US-style market structure European derivative exchange called CEDX. But I'm here to talk to somebody that I've known for a few years. And just like Paul mentioned as well, I'm really sad that I can't be there in person this year. Hope to be there in person next year. But I'm here speaking to Yuri, co-founder and CIO of Granite Alternative Group, a long-standing volatility hedge fund manager and professional. I'm going to pitch some questions to you, Yuri. And then maybe we can spend a minute or two at the end just talking about some of the stuff. First, it's too bad you couldn't be here. It's been a really nice conference, a real nice show. So we hope to see you next year. Absolutely. Yeah, I'll be following it online from this hotel room over here. So yeah, I do hope to be there next year. So let's start the questions. So Yuri, which market and macro events had the largest impact on strategy, decisions, and performance this year?
So the two big macro events that I could think about is obviously we just had the U.S. elections that we all have been following, and there was another actual event in August, which was the unwind of the yen carry trade, which I feel not so many people have been talking about, but it was definitely a major event. If you guys remember, what happened was that the Japanese, the yen unwind carry, there was a trade that was going on for about a decade. And because the Japanese central bank decided to hike the interest rates by a quarter of a point out of nowhere, the Japanese stock market tanked about 12%, which is a major event if you think about it, because it's the fourth largest economy in the world after the US, China, and Germany, of course. And we don't really talk about it, but Japan still is the fourth largest economy. So a 12% move, one day 12% move in Japan is huge. But it was almost like the flash crash, right? It happened one day and then everybody forgot about it. That 12% move dragged the US market about 4% overnight before the open. And another thing that did was caused some fear in the markets, and implied volatility spiked. So the VIX index had its biggest one-day spike ever, actually bigger increase than the Volmageddon back in February of 2018. It was less talked about, but in our space, obviously, it was a major event. Unfortunately, our fund caught a bit off guard. Our signals we were in risk off mode, but we still had some positions that were exposed to this type of move. However, what was nice about the way that the hedge fund functioned is that the risk management worked well. So even though, which I think is a big test for a hedge fund, because you always have your positions, your views, your signals. If it's a systematic fund, it's really less views but your models and signals and so forth. And the question is, what happens if that doesn't work, right? So this was classic type of event where, okay, our models didn't pick it up, our signals didn't pick it up, but the risk management worked well. We had a loss, but it wasn't so significant. There were rumors of other funds, blowing up in the volatility space, closing shop, losing 40%. So we did fairly well, especially speaking to U.S. institutional investors that know the space, and so that obviously had a huge effect on us. And then the Trump, the elections and Trump winning. Prior to the election, there was a big gap between monthly and weekly implied volatility, and that also had an effect on one of our sub-strategies because we're selling weekly options, and it seemed like volatility was elevated, but really the weekly options were pretty depressed.
Thanks, Yuri. Yeah, I think living to fight another day is incredibly important. The nimbleness of risk management. I mean, you rightly stated there were several funds, 3 or 4 that I know off the top of my head, that had some really significant losses just from that one event. So, exogenous events by nature almost impossible to predict. It's how you react to them and also how you refine your models. So, thanks for explaining that. Let's just talk about your core strategy for a second. So, it involves selling weekly options on the S&P 500 to capture the volatility risk premium, i.e., the natural bias in the market to get paid for providing insurance. Another strategy focuses on the shape of the index term structure. So what changes have you made to balance and adapt your volatility strategies over the course of this year?
So usually we try not to change our models too much, because obviously they have better periods for certain sub-strategies, and then there are periods where the performance isn't as good. So we try not to change it too much, but obviously an event like what happened with the yen carry trade, we did do some tweaks in our models. We changed the positions a bit, where before we had a 1-to-1 spread, and we changed that to 1 and 1.5, which does better in these types of, kind of extreme events. But I think the biggest thing that we always do and we continue to do is innovation, right? So that's one of the things that we're always doing. We're always investing time in R&D. We're always trying to develop new sub-strategies. We have 2 sub-strategies that are in kind of a POC process currently this year, which are doing well. We're also looking at external managers to come in with new ideas. And I think that's a key thing. They always say that if you're not moving forward, you're moving backwards, especially in the technology world. I think it's the same when you're talking about any business and in finance as well.
And did you have any observations on the daily options? One of the significant mega trends we've had in listed derivatives over the last couple of years has been increased volume, exponential increase in volume of S&P 500 zero DTE, 0 days to expiry options. And just to give some context to the audience, if you're not familiar with this, these are options that are traded on the day of expiry. At SIBO, we list them 5 weeks out, as well as the regular serial expiries as well. And to give you context, 4 years ago, 20% of our S&P 500 volume was 0 DTE. And as of yesterday and as of the last year, it's around 50%.
Huge. Yep. We do trade the 0 day mostly for tail hedges. Because our original premium collection strategy is a weekly strategy, and sometimes when we're tail hedging, we might choose to hedge for 1 day further and then roll the hedge. So we do use it for that purpose. I think it's too early to tell, but there could be an effect of kind of the fact that the 0 day options came about is depressing premiums. However, like I said, it's too early to tell. It could also be the fact that we're kind of moving into a lower volatility regime over the past couple of years. So VIX has definitely come off from 2022, where it was much higher. So that could also be part of it. But it also could be the 0 day options.
Thank you. Yeah, I mean, I was at an event in Munich just last week, and there was quite a few what we refer to as professional retail traders. So, people that are not institutions, but have a level of sophistication in their strategies. And one of the common strategies that people are doing, and if you look on the Reddit boards and 0dt.com, is, regular selling of put spreads and put spread collars to capture premium. And they've also observed that perhaps the premium that they're harvesting has been squeezed a little bit, whether it's by crowding or whether it's by changes in the volatility environment is still TBC. I guess it requires a bit more research. Thanks. So your strategies are designed to complement a broader multi-asset portfolio. Global interest rates, well, I mean, up until last week appeared to have peaked. We're yet to see what the Trump effect is going to have on longer term interest rates. Certainly there is some talk about inflation coming back in on the back of infrastructure spending, etc. But for now, they seem to have peaked and have been steadily coming off. And the US equity markets have undoubtedly hit multi-year highs. So how do you see the role of volatility strategies within a global portfolio now? Has anything really changed?
One thing that's changed, which is I just mentioned, is the fact that we might be going to a lower volatility regime, and that's already been happening in 2023 and 2024, coming off the highs of the VIX in 2022. So, the vol space, even though it's niche, there's a multitude of strategies, right? There's short volatility, which might be affected by a lower volatility regime because you're obviously collecting less premium. But there's also long volatility strategies. There's relative value strategies. So there's different types of strategies. So depending on what we're going to see in the future, you know, it could benefit different types of these strategies. But in the end of the day, I think what's interesting about the volatility space is that it does have lower correlation to equities, which I think is ultimately what most, at least institutional investors, are interested in. We just saw the guys on the panel that everybody's talking about lower correlation. And so I think volatility strategies always have a place in a more sophisticated portfolio where they can balance out other different types of strategies.
Yeah, certainly. There's a couple of managers I know that focus on tail risk strategies, and you know, a tail risk strategy on its own doesn't look like a great thing to own in isolation. But the analogy that is often used is these are like the brakes on a Formula One car. So it's not the fastest car, the car with the fastest engine that goes around the track quickest. It's the one probably with the best brakes. And so volatility strategies by nature can complement a range of multi-asset portfolios. And it's interesting to hear about the fact that you've always got a couple in testing ready to add to that stable of strategies that you've got. I think we're out of time.
I think so.
Okay. Well, thank you. Hope to see you in person soon, and hope to see the rest of you in Tel Aviv next year.
Bye-bye.
Thank you.
So thank you very much for all of you who join us, and looking forward to seeing you next year.